Hi, and thank you for joining us today for our virtual silver conference. Well, we are living through some crazy times and market volatility has never been higher. Financial markets around the world are getting pounded. The US dollar is under pressure. Bond yields are spiking. And during these tumultuous times, it's very important to reduce risk and fortify your portfolio. And one way to do that is through precious metals. And both gold and silver are performing very well despite the global turmoil. Our last virtual conference was focused on gold and how it can benefit your portfolio. And if you missed it, there's a link below in the show notes. I would encourage you to check it out. Today, though, our conference is focused on silver. And even though gold is trading at or near all-time highs, silver is nowhere near its all-time high at $50, which was achieved in 2011. And yet the fundamentals for silver have never looked better. Peak silver production occurred in 2018 at 920 million ounces, and production has been declining ever since. But demand just keeps climbing, and it's now at 1.2 billion ounces annually, resulting in deficits in the last 3 years. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold, and quite often this ratio is used to indicate how cheap or expensive silver is in relation to gold. It is currently at 100 times, and this is up from 30 times that we saw in 2011. When will silver break out and make new highs? Should silver be part of your investment portfolio? And if so, should you own physical silver or silver equities? To answer these questions, we brought together industry experts along with a number of silver companies. The industry experts include John Ciampaglia, CEO of Sprott Asset Management, Maria Smirnova, Chief Investment Officer of Sprott Asset Management, Michael Oliver of Momentum Structural Analysis. Company participants include John Miniotis of AbraSilver Resource, Benoit of Aya Gold and Silver, Shawn Khunkhan of Dolly, Varden Silver, Brad Langille of GoGold Silver and Gold, and we conclude with Randy Smallwood of Wheaton Precious Metals. We would like to thank our corporate sponsor, Sprott Inc., a global leader in physical gold and silver bullion trusts. Don't forget to subscribe to our channel, Bloor Street Capital, and also hit that notification button to be kept up to date on future events. You can also follow us on Spotify and Apple Podcasts. I hope you enjoy the conference. John, thank you very much for joining us today. How are things in Toronto?
Things are good in Toronto, waiting patiently for spring, and we have been incredibly busy with the markets in the last few weeks, given everything going on in the
That's
world.
great. This is what I want to talk to you about. And the Sprott name is synonymous with precious metals. And given the move that we've seen in the past year in both gold and silver, I thought it would be a good idea to talk to you to find out what you're seeing in terms of flows into your various products. And the Sprott's largest product is the Physical Gold Trust, or PHYS. And with gold up 25% on the year, give or take, what's the AUM now in that physical product, and how have the flows been?
Yeah, well, I'm very pleased to share with you that we recently crossed the 12 billion US dollar mark. And you may remember, I think it was on January 5th of this year, you and I sat down to do an interview in our office, and you asked me the question about our gold trust and flows in the gold trust. And I said to you, while we did like a little over 300 million last year, we were very disappointed with that number. And it was because gold had performed incredibly well last year, and we just thought investors weren't paying attention. I'm very happy to report that in the last couple of weeks, we've had single trading days where we've raised in excess of 250 million US dollars on each day. And that is a pretty good sign to us that investors are finally paying attention. So the market appreciation of gold has been incredible this year. I think we're kind of matching where we are year to date for the full calendar year last year. So the appreciation in the price is obviously accelerated. But more importantly, I think investors are finally participating by adding new capital to the sector, and we're obviously getting our fair share of it.
That's good to hear. Yeah, some of the daily moves in the price of gold are quite astounding. John, the next product I want to ask you about is the Physical Silver Trust, or PSLV. What's the AUM in this product, and what have the flows been like?
Yeah, I'm also, pleased to report that the PSLV has recently crossed the $6 billion US mark, and that makes it the second largest physical silver ETF in the world. So we're quite excited that we've had good performance from there. We've had very good relative flows compared to the competitor. But I think it is important to highlight the differences in sizes between the two markets. We look at all the gold ETFs around the world, and believe it or not, they now stand at 350 billion US dollars in collective AUM. And to put the silver ETFs into comparison, they're about 1/10 of that size at about 35 billion. So much, much smaller market for physical silver ETFs. And as I said, we've got the second largest at 6 billion. Flows in that product have been very positive this year for us. I think we're outperforming even our larger counterpart. And that's a very good sign that people are focusing on funds that have 100% fully allocated metal, segregated and stored outside of the bullion banking system.
And I'm not sure if you can answer this question, but do you have any idea who the buyers are and what jurisdictions they're from? Are they retail buyers, institutional buyers?
Yeah, I mean, one of the big challenges with ETFs is the transparency of the shareholder base. We obviously talk to investors from around the world, everything from do-it-yourself investors to advisors, RIAs, institutional investors. We are clearly having more and more conversations, I would say, with wealth advisors. I think that's being driven by their clients and some of the emerging portfolio risks that people are trying to deal with. And they're obviously looking at precious metals again, many for the first time, many for the first time in years. So I think that's what's really helping to drive renewed interest and obviously renewed sales into many of these funds. And it's I think a global phenomenon because everyone's dealing with the same risks in the world right now. So I think people are looking first and foremost at gold, given its more traditional safe haven characteristics, and silver obviously plays that role as a monetary metal, albeit it also has many industrial applications.
And you and your team are always on the road marketing through North America and Europe. Do you get a sense that there's a lot more interest in the sector?
Yeah, I think there's a definitely emerging interest that's just starting to formulate. We obviously see that in the flows going into gold and silver products globally, which we track every day. I think as I said, it's top to bottom. We recently had a discussion with a large pension fund that basically said they came to the conclusion they just don't have enough precious metals in their portfolio, and they wanted to basically pick our brains on how to go about doing that. And I think that is happening more and more today, where institutions are saying, the traditional role of bonds as a shock absorber to different shocks, whether it's equity, volatility, and obviously we've got this tariff and trade war emerging, is just not playing the same role as it once did. And I think that's one of the reasons why gold has really reasserted itself as a monetary metal, because it is performing very well against the backdrop of incredibly high volatility and a lot of risks that nobody thought about even 3 months ago.
And every asset class seems to be under attack: stocks, bonds, the dollar, and the only one that's really hanging in there is gold.
Yeah,
And
I
to a
think
lesser extent, silver.
yeah, gold has obviously proved itself over millennia as a store of value. And if you go back to numerous financial calamities and dislocations over the last few decades, it has always been kind of a safe harbor asset class in those kinds of storms. And once again, I think gold is proving its worth by being very resilient against a backdrop of a lot of volatility, including traditional reserve assets like treasuries, US treasuries, and the US dollar, which have been very soft of late. And I think investors are clearly rotating to gold as an alternative asset class.
So let's do a deeper dive on silver. Gold is making new highs every other day, but silver is nowhere near its all-time high. And the fundamental backdrop for silver has never been better. The silver is the second most used resource in the world, second only to oil. It's used in over 10,000 different products and applications. Annual demand is keeps increasing. It's at 1.2 billion ounces, far outpacing production. And if the sector is continuing to run at a deficit every year, why is the silver price lagging compared to the gold
Yeah,
price?
yeah, it's a great question, and it is incredibly, I think, frustrating for us and our investors that silver is just not catching more of a bid here. If you look at the gold to silver ratio, which basically is a barometer of relative, value between an ounce of gold and an ounce of silver, I think yesterday we hit 100 to 1. So you can basically buy 100 ounces of silver for every 1 ounce of gold. That is about as extreme as I can ever remember seeing it. Even at 80, it's considered extreme. So 100 is really off the charts. It really does reflect one, gold's incredible run, and two, silver just not participating to the same degree. So why is it not participating? Well, as I mentioned earlier, it is an industrial metal. There is incredible anxiety and uncertainty about potential global recession, trade wars, which are obviously catching a lot of products that are made in China. If you think about solar panels, which China dominates, about 20% of the silver supply goes just to solar panel production. So there's definitely some negative downdrafts on the industrial side that are weighing silver down. The other element that is not propping up silver is obviously it's not a monetary metal that is held by central banks like gold. So obviously central banks have been huge buyers of physical gold the last 3 years. They don't accumulate silver just because of the value to volume challenge with silver. We tend to see more retail accumulation of silver. And we are starting to see groups around the world shifting buying preferences from gold to silver. I think the one that is probably the most interesting is Indian investors. When the price of gold gets very elevated and out of reach for them to buy, they tend to shift their buying preferences to silver. So we see huge amounts of silver being shipped to India as a monetary asset. But the industrial side is clearly weighing on it. And, silver at around $32 an ounce, it's hard to say this, but we are still way off, the highs of $50 that were achieved over 10 years ago. It's hard to find a commodity that is still so far off its last high. And silver is one that to us feels like it needs a big catch-up trade here.
Yeah, so a couple of points. You mentioned the gold silver ratio at 100 times right now. Back in 2011, which was the last time silver peaked at $50, it was trading around 30 times. So it has a long way to go before it catches that or achieve that same sort of level. The other thing I just want to clarify is you talked about the industrial demand for silver. And so just so I understand you, you're saying because there's such a high percentage of the demand is used for industrial purposes, it's starting to trade more like oil and copper.
Yeah, exactly. It's a hybrid metal. It's a bit of a chameleon silver. When the economy is under stress or there's uncertainty about the economy, you find that silver starts trading more like copper, which is obviously a key industrial metal. Right now, it seems to be more heavily influenced on the industrial side as opposed to the investment side. And just, I'm going to share one stat that really shocked me is that earlier I referenced those gold ETFs and silver ETFs globally, and obviously we've seen some pretty significant inflows into gold ETFs. Our last measure here indicates about 25 billion have gone into gold ETFs year to date. If you compare it to silver, the silver ETFs globally, we're only at 500 million year to date. So you can see the relative skew of investor flows going to gold ETFs as opposed to physical silver ETFs. And obviously, as I mentioned earlier, the relative sizes of those two categories are kind of 10 to 1, but the flows are obviously way skewed to gold ETFs right now. We need more investors participating in silver to give it a boost for sure. The focal point is gold. And, much like we saw in 2020 during COVID, gold was the first mover. It broke out first. And then a few months later, what did we experience? Silver kind of caught up and slingshotted right by gold. We wouldn't be surprised if another dynamic kind of played out at some point this year.
So I want to ask you about the silver price. Earlier in April, the silver price got hit relatively hard. It went from $30 down to $27 in a relatively short period of time, and it has recovered. But do you have any color on that move?
Yeah, I mean, it's very frustrating to see those kinds of intraday moves in silver, and they seem to be disproportionately being driven by the paper markets or the futures markets, where people are dumping huge amounts of silver through derivative contracts, often at kind of funny times of the day when markets are thin. It does feel to us like somebody is trying to move the price of silver around from time to time, which is very frustrating to see. But as you mentioned, silver has kind of bounced back here and is behaving a little better. We definitely see another dynamic happening with the tariffs. The proposed tariffs are not impacting bullion in the United States. So we've definitely seen, I think, a little bit of a cooling down around this heavy shipment of silver from London vaults to COMEX vaults in the US. That potential arbitrage is dissipated, and we wouldn't be surprised if the flow of silver from Europe to the US stops and actually starts to reverse. We may see some metal starting to go back, but some of that is created some noise and extra volatility in the silver price in the last few weeks for sure.
John, you and your team have recently created two new products for investors who have an interest in gold and silver, the active gold and silver ETF and the silver miners in physical silver ETF. Can you just tell us about these two products and how they might benefit investors?
Yeah, well, our silver miners and physical silver ETF just crossed the $50 million mark. And I believe it's the fastest fund that we've launched to hit 50 million in the last 10 years or so at Sprott. So we're very pleased with the initial reception. We created the underlying index that it tracks in very close partnership with the NASDAQ. They have an indexing team. And really, why we brought this product to market is to complement the Sprott Physical Silver Trust. As I mentioned, it's the second largest physical silver fund in the world, and we often find investors want to play the silver miners. The challenge with silver miners is that there aren't many left. Many of the silver miners, even though they might have silver in their name, their company name, are actually gold miners in disguise. And it's increasingly hard to get pure play silver exposure. So when we designed the underlying index, we really wanted to make sure it had the maximum amount of silver exposure with the underlying constituent companies. And when we looked at some of the competitor ETF indexes, what we found is that you only get about 30 to 35% exposure to silver by investing in those underlying indexes. Most of the exposure you get is gold and other metals. So what we've done through our process is painstakingly go through each company to ensure we're only focused on the companies that derive a majority of their assets from silver. And so when you actually drill into our constituent holdings, what you find is about 70% of our holdings are directly tied to silver, silver mining, or silver assets that are in development. So we think it's the most pure play index in the marketplace, and we're very pleased with the initial investor reception to that product coming out a few months ago. And then secondly, we've launched our first actively managed ETF and first actively managed gold and silver mining ETF in the world. So we're quite excited about this offering. This is kind of modeled after our flagship gold equity fund that trades in the United States. It's not a perfect replica of the fund, but it largely will represent the holdings of our mutual fund. And what we really wanted to do here is provide our active gold team stock picking expertise in what I think is fair to say a more popular investment wrapper, which is the ETF. People like having that intraday liquidity, the transparency of holdings, lower fees, and obviously for US investors, greater tax efficiency with an ETF versus a mutual fund. So this fund is also quite new. We've recently broke through $30 million in the fund. So again, very good reception as people are starting to buy GBUG, which I think has a great ticker as well.
That is a good ticker. Well, that was a great overview, John, and I want to thank you very much for spending time with us today. If someone would like to learn more about Sprott and its various gold and silver products, where can they go?
Yeah, we encourage you to start your journey by visiting us at sprott.com. We have a ton of educational material, insights for you to help educate yourself about these different categories. You can also phone our sales team. We have a 1-800 number on the line if you want to speak to somebody to better understand what we're all about and some of the differences between our offerings. We'd encourage you to start your journey there.
Once again, John, thank you.
Thank you for having me. It was a great chat.
Hi, I hope you're enjoying the conference. Just a reminder to subscribe to our channel, Bloor Street Capital, give us a like and leave a comment. Thanks for your support. Hi, John. Thank you very much for joining us today. AbraSilver is an advanced stage exploration company in Argentina in the province of Salta. And as we both know, jurisdiction is so important when it comes to mining. And the province of Salta is often regarded as one of the most mining-friendly areas in South America. And why don't we just start right here? Tell us about the province of Salta and why is it so good to mine in?
Well, first off, thanks very much for having me, Jimmy. Really appreciate the opportunity. And yeah, without question, you're right. I think Abra is very fortunate to be located. Our project, Diablilos, is located in the Salta province of Argentina, which has really emerged, I'd say, as one of the most mining-friendly jurisdictions in all of South America. So the provincial government there has really managed to create a stable, supportive framework for mining investment. They have a very streamlined permitting process, and without question, a pro-development approach. And so Salta's always been known as a great jurisdiction within Argentina, and it's been recognized by the Fraser Institute and several others as being the most mining-friendly provinces within not just Argentina, but all of Latin America. And that's based on recent Fraser Institute surveys. And so in addition to being in Salta, I'd say the other positive catalyst for us right now has been the positive changes that we're seeing at the federal level in Argentina. So of course, with President Milei taking over office a few years ago now, he's recently offered some major incentives to attract new investments into the country. We could talk about the key one there being the RIGI regime, but I think very supportive pro-business agenda right now in Argentina as a whole. So we're ideally located at the right place at the right time as we're looking to advance our project towards a construction decision here in the near term.
When I hear you talk about this in how positive the governments have been to the development of mining, the mining sector, it makes me wonder, or makes me realize how important government is, and if they're putting forth the right policies at the provincial level and at the federal level, how successful an industry like mining can be.
Without question, that's always a key variable. And for us, of course, being again at the right time in Argentina certainly is helping us advance our project. I think one of the key obstacles in Argentina has historically been the FX restrictions, which have now just been lifted just as of last week, really. And so the new administration coming in, lifting FX restrictions, etc., opening up the market, and then offering major incentives. So reducing taxes, eliminating export duties, offering 30-year stability agreements, really make it very attractive now for new investments coming into the country.
Very interesting. So let's talk about AbraSilver in a little more detail now. And the company has gone through a major transformation in the last few years, and you and your team have done a lot to grow the resource. Can you just take us through a brief explanation on what you've done in the last few years and how large the resource has grown?
Sure. So our team took over running this project at the start of 2020, and so it already had a large resource, about 130 million ounces of silver equivalent, and so we've been drilling that year over year, and all credit goes to the exploration team down at site. They've really done a phenomenal job for us, just consistently growing the resource base through the drill bit on a very cost-effective basis. And so when you look at the trajectory of our resource growth each year, we've been able to add anywhere between 30 to 60 million ounces of silver equivalent in the ground. That's all in the measured and indicated category. And what we're really proud of is when you look at our average discovery cost, that's averaged only 11 cents an ounce. So it means for every 11 cents we spend on drilling, we're adding an ounce of silver in the ground. And so, phenomenal rate of return on our exploration dollars. Yeah, I think the key, obviously, there to the success has been, well, there's a number, I guess. First off, you need a great project, which we certainly have. You also need a great technical team at site as well. And then, I'd say we've also, on top of that, been able to maintain a very disciplined, value-driven approach to exploration. And so we've been able to ignore fluctuations in the market and a whole bunch of other noise, and just really maintained a very focused approach, looking at adding the most bang for your buck on the exploration side. And I think when you look at the track record, our team has certainly been able to do that over the last several years now.
Hey, John, when you talk about the cost to discover, you said 11 cents for 1 ounce of silver?
Correct. For every, yeah. So when you take the total amount that we spend, let's say we spend $10 million on drilling, I mean, how many ounces did we find for that? And you just divide the two figures.
And how would that compare to Canada or the US?
Yeah, I mean, I've tried benchmarking that to many of our peers. Unfortunately, most don't really report that figure, and I think that's unfortunate. As an exploration company, that should be one of the primary metrics that people put in their presentations. And then it's kind of hard to back out from the financial statements. You don't know what other costs, like there's not the exploration costs, but we're including laboratory costs, G&A at site, all types of costs. But yeah, no, certainly from what the work we've been able to do, I think we certainly feel very confident that we have the lowest, if not certainly one of the lowest, all-in discovery costs in the industry globally for all sort of silver explorers out there.
And how many ounces are you at right now?
So right now we have about 260 million ounces silver equivalent. And we're actually working on another updated resource estimate, and that should be coming out in a couple months now, in July. So again, we expect that the number is going to grow once again. So we're sitting at 260 million ounces silver equivalent currently, but again, expect an update on those figures within the next couple months here.
And you also released a pre-feasibility study in late 2024. Why don't you take us through the highlights of that study? NPV, the CapEx, and anything else you think is relevant.
Sure. Yeah. So updated pre-feasibility study, as you mentioned, in December. And so this is looking at a large scale open pit operation. We have, based on the reserves from the November 2023 resource update, we're sitting on a 14-year mine life. It's going to be a large scale operation. 9,000 tons per day will be the throughput, entirely precious metals focused. And so the economics worked out to about 60% silver, 40% gold over the life of mine. And so 100% precious metals focused. And I think what really stands out here is the average annual production profile in the first 5 years. We'll be producing over 11 million ounces of silver, about 60,000 ounces of gold, So when you convert the gold into silver equivalent, it's over 16 million ounces of silver equivalent production every year on average for the first 5 years. And what's important is very, very low all-in sustaining cash costs. So certainly well within the lowest quartile. Cash costs, all-in sustaining, will be under $12 an ounce here for the first 5-year period. So tremendous margins, lots of production here, low cost, large scale. And when you run the numbers, I think for our base case, we used very, very conservative commodity prices. So we used only $2,050 gold. Of course, gold now is sitting almost $1,300 an ounce above that. And then we used about $25.50 silver. And when you run those economics, this project had about a $1 billion net present value Canadian. But if you look at current spot prices, so again, closer to, over $3,000 gold, about $33 silver, the net present value there would be more than double. You have a project here with a net present value of over $2.2 billion Canadian. You'd have after-tax rate of return in the high 40s, so over 45% after-tax rate of return. And a very, very short payback period, less than a year and a half to get back your initial capital costs. So without question, I think a very, very robust project, large scale, long mine life. And again, with the feasibility study, we only expect many of those numbers to continue to improve here.
So you're adding value through the drill bit, and you touched on this earlier, but you're also seeking approval for what you call RIGI, which is an acronym, RIGI. And when approved, this will also add a lot of shareholder value. Maybe you can just take us through exactly what this is and how it's going to add value.
Perfect. Yeah, so RIGI is absolutely key for us. And so that is President Milet's economic sort of incentive regime for new large investments in the country. And so right now, that was passed in July of last year, 2024, and it's effective for 2 years. So currently, RIGI is set to expire in July of 2026. And so you really have to get approval, of course, before it expires, which we will do. We'll be getting approval in early 2026. And then once you're approved, you then have 2 years to spend 40% of your capital costs. And your total CapEx to qualify has to be north of $200 million. And so this is meant to, again, incentivize new large-scale investments within the country, not only in mining across all sectors, but of course, mining is going to benefit tremendously from this. And what this does is it gives you a 30-year stability agreement. So again, no foreign exchange restrictions during that time, predictable taxes, gives you a tax break. So your corporate tax rate would only be 25% instead of 35%. Eliminates export duties, which are currently very high, 8% for gold, 4.5% for silver. Those all go down to zero under this new RIGI regime. And so this is a massive, massive benefits here being offered by the federal government. It would result in us saving hundreds of millions of dollars in lower taxes, lower royalties, lower export duties, etc. And just gives us a lot more certainty. So we'll be applying for RIGI in early 2026, and then we have 2 years to spend 40% of capital costs. So we'll have until early 2028 to really commit to spending 40% of the capital costs. And that fits perfectly within our current timeline. So we'll be looking to make a construction decision in late 2026 with a full year of construction in 2027.
And so why don't we talk about your drilling program? You just finished up phase 4, and maybe you can just touch on some of the highlights, and you've just begun phase 5, and maybe you can tell us what the purpose of that drilling program is.
Yep. So phase 4 was another 20,000 meters of drilling. Again, as you mentioned, we just completed that now. And so that was really meant to continue to expand the main deposits that we have. We have 2 main deposits here sitting near surface. Oculto is the main deposit. That continues to grow. So we've been drilling extensions off the main Oculto deposit. And then the new high-grade discovery that we made a few years ago called Jack continues to grow as well. And so we've been growing Oculto and Jack. And again, as I mentioned, we'll be publishing an updated resource estimate on that very shortly. And then that's going to form the basis of our feasibility study, which will come out in early 2026.
And I'm sorry, did you touch on phase 5?
So phase five, yeah. So that was phase four. So that was phase four. That's been completed. And now we've gone to phase five, which is now well underway. That's an additional 20,000 meters. So we just completed 20,000 meters. Now we're doubling down another 20,000 meters. And this is, again, focused on step-out drilling. So this is looking, again, continue to expand Oculto and Jack is obviously a key area of focus. But now we do have a number of other exploration targets as well, earlier stage exploration targets. There's this one area that we're quite interested in called the Sombra target. That's a bit to the south and east of Oculto and Jack. Earlier stage, we've announced already a few holes from that have been quite encouraging. So we're continuing to following up with several new holes at that Sombra target. And then we do have a very, very exciting, our land package is quite large land package, about 4 kilometers away from the current resource. We have this whole porphyry district that has large scale potential. And so we're going to be drilling a few targets there as well as part of this phase five. So again, phase five is really focused on just continuing to grow the resource here, step out drilling with lots of blue sky potential, I'd say, ahead of us here.
So you're, just so I understand you, you're just trying to define the outer boundaries of this deposit.
Correct. Yeah. So out of Oculto and Jack, continue to extend that. And we want to find the margins here and then drilling these new areas as well that have never really had significant amount of drilling on them.
So why don't we talk about your balance sheet now? Because it sounds like you and your team are very busy with drilling and also working on an updated resource. So that's going to require a lot of capital. How much cash do you have on hand?
Yeah, so that's a great part. I mean, earlier this year, in February of 2025, we completed a well oversubscribed financing. We raised just under $60 million. That's 60 Canadian. And so we're fully funded for all of 2025, all of 2026. We're actually fully funded to get to the construction decision stage. And so not expecting any additional financing here in the foreseeable future. And so with the balance sheet, I mean, we'll be looking to spend, again, about $10 million US on exploration this year. The feasibility study will cost about $10 million US as well. And then, our G&A is about 5 million or so, roughly. So about 25 million there over the next 12 months. But again, we have 60 million Canadian roughly in the bank. So a nice buffer there on the balance sheet to let us finalize the fees, get the permits in place, complete another 20,000 meters of drilling, and really set us up nicely to make that construction decision later in 2026.
And I guess that's one of the good things about these markets with gold and silver trading, gold trading at all-time highs, silver not quite at all-time highs, but it's on its way. But it's easy to raise money. Maybe you said the deal was oversubscribed. Can you give us some more color on it? Who are the participants? Were the Canadians, Americans?
Yeah, so there was actually 2 deals done in parallel. So there was a bought deal, a public offering there that was done. And that was upsized. So initially we were targeting $25 million Canadian. We upsized that to 30. The demand was orders of magnitude above that level. And so, yeah, we capped it at 30. I think that was the right move for us. As we've seen, additional buying, I'd say, in the secondary market. But that was entirely institutional investors globally. So some, of course, Canadians, Americans. A large percentage, I'd say, were Europeans. There are a number of large funds out of Europe, out of London in particular, that really came in, I'd say, quite aggressively, really liked the story and participated there. So that was great to have that bought deal with excellent institutional support. And then in parallel, our largest investors, so namely Kinross and Central Puerto, also did a private placement at the same terms. Kinross maintained their 4% equity interest. So they maintained pro rata. They did not want to get diluted down, of course. And then Central Puerto, which is the largest utility company in Argentina, they used to own 4% interest in us. They elected to go up to 9.9%. So it's great to see their support. They're obviously an extremely valuable strategic partner for us, being the largest utility company in the country. And so, yeah, we had great participation from our existing large-scale strategic investors, And then as well, we're bringing new institutional investors on board through that bought deal offering that we did.
And John, it's not often you hear of a utility company getting involved in mining. Why are they involved?
Yeah, so a number of reasons. So Central Puerto, of course, they're taking a equity investment at this stage. They see lots of upside, of course. Otherwise, they wouldn't buy the shares. So first off, they obviously want to make money on their investment. They see Diablillos as being very attractive, seeing this becoming a project here, a producing mine in the near future. And secondly, they're also seeing Diablillos as a potential customer on the power side. And there, it's a win-win for both of us. And so where we're located in Salta, in the Puna, right now, the plan from our pre-feasibility study is that we will generate our own power plant. So we'd have a 20 megawatt solar plant with diesel generators running in the background to supply ourselves with power. But Central Puerto is looking at doing a large-scale investment in the region and extending the existing grid power and actually potentially running it through our property. So they see ourselves as, potentially connecting to the grid, and that would certainly be a windfall for our project. It would eliminate the capital needed to build our own power plant. And then, of course, on an operating cost basis, it'd be cheaper as well to be connected to stable grid power. And so there's, again, a few different reasons for them looking to invest in us.
And you mentioned Kinross as a shareholder. How involved are they? Are they just a passive investor, or do they give you advice on technicals or drilling targets or?
Correct. So they're a 4% equity level. So a large scale investor, I would say. But we do have a exploration sort of technical committee that meets with them on a regular basis, and they're absolutely very, very valuable. So we always value their advice. They know where we're drilling. They give us advice as to some of the targets, etc. So I think we have an excellent relationship with both Kinross and Central Puerto. They're both extremely valuable, and really we look to them for advice as needed.
So you said there's going to be later in 2026, you're going to make a construction decision. And if everything goes according to plan and you start constructing, when will AbraSilver go into production?
So it'd be first production is scheduled for 2029. So it's about 2.5, just under 3 years of construction. So 2029 would be a partial year with first gold and silver being poured at site in that year.
And when in full production, can you just remind me again of the numbers? What will be the annual production for gold, silver, and silver equivalent?
Yeah. Yeah. So again, large scale, especially over the first 5 years here in the mine plan, be producing 12 million ounces of silver, about 60,000 ounces of gold. And so when you convert that again on a silver equivalent basis, it's north of 16, close to 17 million ounces on a silver equivalent basis. So really positions Diablillos as one of the largest, highest margin, undeveloped primary silver projects anywhere globally, I would say.
Well, John, that was a great overview of AbraSilver, and I want to thank you very much for spending time with us today. As we wrap up, you went through a lot of information on what you and your team are doing here in the next few months, but maybe you can just give our viewers a summary of what news they should expect in the coming months.
Sure. So certainly, without question, very, very busy time ahead for us. And so I'd say, looking ahead, investors should certainly be on the lookout for a number of key catalysts coming out over the next 12-month period. So first and foremost, ongoing drill results for the remainder of this year. And so lots of exploration news, continuing down the pipeline here. I'd say also look out, of course, for that updated resource estimate. As I mentioned, that should be out sometime in July. Also importantly, on the permitting side, we expect to receive our EIA approvals later this year in Q4. And so that would be a major positive development, of course. And then in Q1 of 2026, we'll be announcing the results of our definitive feasibility study, and also looking for approval for that RIGI application. And those would really be the final elements needed here to really position us for a construction decision later next year in 2026. So a lot of news flow here. We think with the positive tailwinds on gold, silver, Argentina as well. Certainly a very, very exciting time for us. And so, yeah, I'd say busy times ahead, but it's good being busy in these types of markets.
Yes, it certainly is. Well, it sounds like you got a lot going for you, and I want to thank you very much for sharing this story with us. Benoit, thank you very much for joining us today. How are things in Montreal?
Things are pretty good in Montreal. We're making the playoffs, so things are pretty good.
Things are on the up and up. That's good.
Up and up, absolutely, for so many years. So yeah, things are good in Montreal, but I'm leaving this weekend for Morocco, so I'll probably miss the first games.
Yeah, that's good. So when I think of mining, there's many different elements that I think about when it comes to a successful mine, and they include jurisdiction. I look at the grades and the scale, and I also look at the cost of production. And when I think about gold mining, I think about Canada and I think about the US. And when I think about silver mining, I think about Mexico and Peru. I do not think about Morocco. So I want to start right here and ask you about the jurisdiction and what it's like to mine there. Tell us about the mining industry and what the government is like to work with.
Well, thank you for this question because it's a very, very good question. And I agree with you. In this world right now, number one criteria for mining and for investment in mining is jurisdiction. It's number one. Management, of course, but jurisdiction can be very, very tricky. We saw it this week in Mali again, and we're seeing it everywhere. I mean, jurisdiction is tricky. Morocco is a major mining center of the world, except it's unknown to most of us, not us, because now we're there, because it's the largest phosphate reserves of the planet. It's the largest phosphate company of the world, and it's been kept like this. It was a strategic decision not to develop the other metals except by a company called Managem, which is owned by the Sovereign Wealth Fund. And Managem was developing all the other assets, and a company called OCP, which is the largest company in Morocco. I always say OCP is to Morocco what Hydro-Quebec is to Quebec. It's that kind of power and strength and positioning. So they've kept this as a secret for 100 years, and only in 2010 have they strategically decided to open up and bring new people in. And that's when Aya was created, and the former management team was buying assets from the state, putting those permits into Aya, developing them slowly. And in 2020, when the new management team came in, we had this fantastic portfolio of assets that had been put together by the previous team. But this is today, and I talk about it worldwide, I think in the mining world, it has to be number one as far as jurisdiction, stability, political stability. The government is pro-mining. There's no NGOs that are against mining. You don't have local tribes and communities that can stop you. That doesn't exist in Morocco. You sure have to have corporate social responsibility and all of the ESG program. That of course is there, but it's a pro-mining jurisdiction, and they're the fastest in the world for permitting. So permitting in Morocco you count that in weeks or months. And around the world, you count that in years, and in some places it's 10 years and more. So best place for permitting, great place with government, support of mining, no NGOs against mining that are making your life impossible, and people available to work. The unemployment rate in Morocco globally is about 13%. In the regions where we operate, it's around 30%. So you have employees, you get resumes every day. There's not a day that we're not functioning because we don't have enough truck drivers. That's not like Quebec. That doesn't exist. I mean, so I've built mine, as you know, all over West Africa. We did things in China, in Canada. To me, Morocco is number one jurisdiction in the world for mining because of permitting, because of the government, the employees, stability. We have power to site green power, wind and solar to site from the grid at 7 cents per kilowatt hour. So, it competes with Quebec on hydro energy. There it's wind and solar. So again, I'm completely sold to Morocco. This week at site, or I should say last week, we had 8 people that visited the mine, the Zgounder mine. We had 4 analysts and 4 fund managers, and they're always coming out saying, you know what? One of the best mine tour ever. Country is unbelievable. And I had one of the fund manager, and she said, I love this country. I just love this country now. Like it is very different, and I would recommend you and all your viewers to have to go to Morocco, visit the country. It's the fastest growing country probably in the world right now, GDP wise. And it's a nice place to be, and aerospace is there, automobile, tourism, and mining. So we're very pleased to be the largest non-government owned entity in the mining space.
So let's spend a little more time talking about your assets, and your primary one, as you mentioned, is the Zgounder silver mine. Forgive my pronunciation, but the
You're
full
good,
year
you're good.
But the full year production in 2024 was 1.6 million ounces of silver, and it's going to grow to 5 million or over 5 million ounces in 2025. And that's because of a lot of work you and your team did with mine expansion. Tell us about this mine expansion and what exactly you did.
So when we took over in 2020 and when we arrived, what the previous team had done was to build a small Chinese-built plant, which was very fragile and broke down quite a lot. At the time, plant availability was like 42%, which we wanted to be 95%. So it was very, very low. And we came in and we fixed that. And the capacity of that little plant was 1,600 ounces of production per year. It was like 700 ton a day of ore being treated. So that was fine. But after 2.5 years of drilling, because they did very little drilling historically, we had 70 million ounces of reserves, and we were producing 1.6 million ounces a year. So that was like a 50-year mine life or 40-year mine life. Made no sense. So we decided to build a brand new state-of-the-art plant. So we did the feasibility for that. We did all the detail engineering, and we built it in 2020, 2023, 2024. It was about an 18-month build, and it concluded in December. So we did the official commissioning and completed the commissioning as expected in December of 2024. The construction lasted a bit longer, so there was a bit of kind of negative news that we were late. We were late in receiving the plant, but we did the commissioning in 3 weeks instead of 3 months. So because it was so well, it's well built, and our team did a fantastic job. So by December 30th, it was commissioned, and now we are what's called ramp up. So we had 3 good months, in January, February, and March. And of course, you're tweaking and fixing and changing the recipe. And but now, so Q1 came out last week. We had 1,070,000 ounces of production, which was better than our budget. So we did better than what we had anticipated. And now we are in the ramp up. So Q1 is 1 million, Q2 will be higher, 3 higher, and Q4 higher. We expect to exit the year on a 500,000 ounces of production per month, which is 1.5 million per quarter, which would take us to the 6 million ounces a year of production on a going forward basis. So this year, 2025, we'll be doing around 5 million ounces of silver, pure silver. I wanted to show you this. This is the number 1 from that new mine. They gave it to me when I was there. They say, okay, you can have that. It says, see, number 1 here, 001. And they gave this to me as a gift, of course, to be paid, but as a gift. And the employees actually did that, not Aya, but the employees paid it, bought it, and gave it to me as a thank you note. So so this is number one that we have here, and now we're producing approximately 15,000 ounces per day. And it's going, it's a ramp up. So I won't say it's going extremely well, because in a ramp up, you got, pumps that break, you got this that you have to change. Then you realize there's a bit of under design on this capacity at this plant, at this pump, but this is normal stuff. It's all being done. It's going quite well. We're going to have a very, very nice 2025.
And that's a good point. I want to talk about valuation, but before we do that, a couple of other questions. You mentioned that you're still in the ramp up mode. When do you think that's going to end? When will you be at full plate capacity?
So towards the last month of Q3 or all of Q4, that's kind of the plan. But we're close. We're close. I mean, as I mentioned, the run rate should be about 500,000 ounces of production per month, and we won't be there in Q2, but we're climbing up. We did about 330 average in Q1. We should do probably 400 average in Q2, and climbing up to the 500,000 ounces per month for Q4. So that's the goal. That's what we have in mind, and we're working towards this. And now it's adjustment. Hey, now the plant's running correctly. Now we need to bring the recoveries to where they should be, which is 88, 89%. Right now they're more 82, 84, and this is just chemical. It's not that the plant's not working. It's we need to have the right chemical adjustment. It's really now like a two-star Michelin restaurant. We need to make sure that the carrots, the food, the meat is all coming perfectly at the same time, and we're working on that as we speak.
I like that analogy. But to your point, as you continue to move forward and the mine continues to ramp up and your recoveries improve, you're going to continue to de-risk this stock, and there's going to be improvements in the stock price. So to your point, it's probably a good entry level.
I really believe it is. I absolutely believe it is a very, very good entry level. And again, I'm going to make sure people know about this. And we're going to be on the road a lot in May, June. Yes, and then we're going to the Rick Rule conference in Boca Raton in July. We'll be there. We're looking. This is my objective, my KPI. I got to make sure that we go back to these all-time highs.
So another big part of your job, as you mentioned, is also exploration. You got to find another source. And why don't you tell us about that? How many meters do you have planned for 2025? How many rigs, and where the targets are exactly?
So the exploration program is divided between the first project, Zgounder, and our second project, Boumadine. So I'll address those at the same time. So at Zgounder, we have what we call Zgounder Regional. And there we have 4 or 5 rigs turning. And based on the targets, we're going to be drilling about 30 to 40,000 meters there, which we kind of do on a yearly basis. That we have a plan. We're using a lot of AI right now on interpretation of the data, because we've done the satellite imagery, we've done the geophysics. We're doing more geophysics. We're even doing seismic now. I had never seen this, but now there's new seismic applied to geology to understand, more at depth the structure. So we're doing seismic as well at Zgounder. We're taking all of that data. We have an amazing geological team there, amazing. And they are reviewing all this using AI and then selecting drill targets to find another structure like what we have. So that's like the small exploration program. The big exploration program is at Boumadine. Boumadine is a tier 1 asset. It's 5-6 hours away from Zgounder, so there's no crossover. It's a standalone. Zgounder is pure silver. Boumadine is polymetallic, so it's gold, silver, lead, and zinc. Today, Boumadine is at 452 million ounces of silver equivalent, or 6 million ounces of gold equivalent. The gold is at 5 grams per ton on 6 million ounces, and the silver is about 450. So when you compare that to Zgounder, it's already 4 times bigger. And Boumadine is, we have a very large piece of land. It's 700 square kilometers. All that, most of it, I should say, most of it, mining permits done already at Boumadine. Of course, Zgounder fully permitted because it's in production, but the other one is also permitted. And there we're going to be drilling 140,000 meters this year. We drilled 110 last year. We've increased the resource by about 100 million ounces of silver last year. We're hoping to do the similar this year, but it is, I believe, and most people say the same, in the mining world, one of the top tier one discovery of the last few years. And it's continuing to grow. So the 450 million ounces of silver is on 5.2 kilometer a strike. That strike keeps going, but we have just discovered another system at the bottom, few kilometers south, where we have 21 kilometer of strike of this similar, not exactly similar, mineralized zone. So the structures that are north-south are gold, silver, lead, and zinc. And the structure that are east-west, it's another geological event. Those are more copper and gold. Copper and silver. So it is a very large piece of land, and we're going to be drilling. So there we have between 11 and 13 drills turning. We have a team of 250 people there on site in exploration. We drill 24/7. We occupy all the lab capacity in the country. That's one of the reasons sometimes the results don't come out as quickly as we would like to, because we just, all the labs are working for us. And that program will continue. I expect that kind of drilling to continue for the next 2-3 years, especially if the south comes out to be well mineralized. Then we'll have to put, I don't know, 20-30 rigs and drill the south, continue to drill the north-south structure, and get going on a PEA. So it's a world-class tier one discovery. Internally, our target is to bring this to 1 billion ounces of silver or 10 million ounces of gold minimum on the main structure, and then copper, silver on the east-west structure. So there, we have a big exploration team, as I said, and we just keep going. We just keep drilling. It's people who go to site come back and say, okay, it's one of the best system I've ever seen. There's nobody around, no one. We have power to site. The government brought us the power line, so we're hooked onto the grid. We have the water from the mountains, and we have employees that come from villages that are further away, but they come to site. So this is who we are. We have this fantastic little ATM machine that produces cash flow. This year, 75 million. Next year, probably more. And then you have this big tier one asset that's being developed. We'll do a first phase PEA for next year, but depending on the discovery and if it keeps getting bigger, the flow sheet may be adjusted for tonnage and for size. But that's a very good problem to have, knowing that Boumadine is already a mining permit. So we could start building it like tomorrow. And that's very rare. So the whole thing is a mining permit. It's already accepted by the government. We are doing all the chapters of the PEA, where's going to be the tailings dam, the water reservoirs, the camp, and all that. So we're doing all of this. It will be 50% open pit, 50% underground to feed the plant. And now what we need to do is decide how big the plant will be. 10,000, 20,000 ton a day. That will be our final decision based on the tonnage that we will have in the resource and in the reserves.
With so many drilling rigs on the go there, I guess the drilling contractors are pretty happy with you guys.
They are. They are. We're of course, taking most of the capacity in country. We also brought another one from outside the country, but on a smaller contract. And but that's why the government want to push mining, because you create the industry, the driller, when we arrived, probably had, I'm gonna give you a number, I'm not sure, he had like 6 rigs, and now he's got 20 rigs. And the labs were doing 20,000 essays a day, and now they have to do 60,000. Or so it's very, very different, because don't forget, you also have the drilling for production. And we drill 3-meter spacing for production. All that needs to go to the lab as well. So you got the drilling from production, the drilling from exploration, and all the geos that are working, the geophysics that we bring into country from different parts of the world, AI, satellites, spectral imaging. They in Morocco, they understand that you can create a big industry. When I went into 1995 to Burkina Faso, there was like 3 of us, and we discovered the Houndé Belt. Well, a couple of years later, there were 400 companies doing exploration. Well, do you imagine the amount of money that brought into Burkina Faso? We were 25% of the revenue of the state. And in Morocco, we're not the same, because Morocco is such a bigger economy, but they understand that mining can be a very nice source of income, foreign investment, and mainly job creation. And that's exactly what we're doing. And we're working hand in hand with them and with the government in doing all of that.
I want to move on now and talk about valuation. You touched on this earlier, but I think you would characterize 2024 as a transformational year for Aya Gold and Silver, and especially with the mine expansion. There was a few issues, as there always is, but production, once again, as a reminder to our viewers, production is going from 1.6 million ounces up to 5 million ounces this year. But even though you have this incredible growth, the stock is still trading at a big discount to its comps. Why do you think that is, and what are you and your team going to do in the coming months to close that valuation gap?
Very good point, and you're absolutely right. But as I mentioned at the beginning, because for 4 years we did nothing wrong. We did everything we touched was perfect. The drill results were spectacular. Boumadine came with the first resource update at Boumadine was 350 million ounces of silver in equivalent in the first resource update. Our cost of discovery is 10 cents an ounce. So the stock did very, very well. People really liked Morocco. There was, of course, at the same time, there was a lot of people looking at South America, with Panama going, going different, being different. Ecuador, Guatemala. I mean, it's so all these countries were complicated, and Mexico were giving wrong signals on open pit mining, and so a lot of shareholders checked out of South America and Mexico and wanted to come into Morocco as a silver kingdom, because it is a silver kingdom. So we had a very good run on the stock price. It ran up to $19, and then came two hiccup, which, if you know the industry, you know it. These are normal. Like the contractor said, "I'm sorry, I made a mistake. I'll deliver the plant 8 weeks late, but we will make it up on commissioning." So there was no effect on the timing, or a little bit, and then the costs were too high. But that's pure explanation, and we had to manage the grade, because the grade was lower a little bit at that time. So that being said, we got chopped into by 40% from 19 to 11. And now, well, it's shareholder confidence. That's why we had 4 analysts at site this week. We'll have 4 reports coming out of that trip. We have analysts coming next week and the week after. We expect there's about 10 analysts covering the stock right now, with 9 very strong buy recommendation. There's 2 or 3 new analysts coming out in the next few weeks with, obviously, I hope, strong buy recommendations. So we're going to take all of that and then go on the road and meet the shareholders. We're also working on a U.S. listing. That's something that we didn't have, which ended up costing us points in the ETF weighting. So we lost a few points on the weighting of the ETF, because our total volume was smaller than others who were trading on the U.S. listing. So we're correcting that this year in 2025. I'm looking at, as well at a Middle East listing. I think that's the future. I think that's where the money is going right now. And the money is there. So there's something we're looking at. We're not announcing we're doing that. We're looking at that. And but the U.S. listing that we're working to get there as quickly as possible. So with the U.S. listing, with us being on the road, with a news flow coming from 15, 16 drills turning, news flow coming from the production at Zgounder, I believe that we will be able to correct the valuation. Now, of course, we've seen a big run in the gold price, and we have not yet seen that in the silver price. I think that once we see this in the silver price, well, then we will, we'll see a lot of the stock move. But us, I think we're going to move a little bit faster. We also have a very small float. We only have 131 million share outstanding, and at the board we have 50% of that. So, or not 50, sorry, 50 million shares. We have like 40 some odd percent. So it's a very tight situation where the float's tight. The big shareholders are there. The ETFs are. These are public. VanEck is our largest shareholder. That's a public information. So look, we're in good shape. We have money in the bank. We're generating cash on a daily basis right now, and we have the right approach. But really, as I said, my job right now is to be out there, talk to you, go everywhere, and make sure that the stock corrects in the coming months. I mean, it took 4 months to come down. It'll probably take 4 or 5 months to correct. But one very big day in silver, and that may change very, very quickly. We still have very large funds that we've been talking to over the past year that we're not in because they thought the pricing was a little bit ahead of itself, and now they're looking at this and saying, that's the right time to come in. So again, as I said, this is my job. I can't call my VP operation and tell him why is the stock low. This is not his job. Or our VP exploration, that's not his job. It's my job.
Well, Benoit, that was a great overview of Aya Gold and Silver, and I want to thank you very much for sharing the story with us today. And as we wrap up, can you just summarize for investors what they should look for in terms of news flow in the coming months?
So in the coming months, you're going to get monthly production because in the ramp up, we've decided to give monthly production. So you'll get April, May, June, and so you're going to get news flow coming out of the production, and where you're going to be looking for recoveries and throughput and grade, and you're going to be looking for plant availability. So the regular ramp up metrics. And we're going to be putting those out because we want to we want to be transparent. And to that, you're going to get drill results from Zgounder and from Zgounder Regional. Then also you're going to get results from Boumadine. So the main zone, we kind of know because we've done 200,000 meters there. It hits every time. So we'll keep giving those out. But to me is the south portion, where in the south portion right now in our grabs, we're looking at 25-30% copper and 200 to 300 grams silver. Won't be there all the time because those are grabs, but that's the kind of rocks that we're seeing on 21-kilometer long. So we're going to be doing more of that work. We're going to be drilling there towards the end of the summer, and where we're getting the road access and all that because there's nobody. We're by ourselves. There's nobody there. So you're going to get drill results. You're going to get operational results. You're going to get more the update. There'll be an update this summer on Boumadine's metallurgy. Some people were saying that they were concerned. We kind of told them, we're going with a very good solution. We'll make that official this summer with the metrics of the flow sheet that we're going to be using for Boumadine, which will also trigger a resource update because the metrics, what we did when we did the resource update at Boumadine, we used the worst or the most difficult metrics possible, saying that whatever we get as a new flow sheet and a new process is just going to make the metrics better, which will come in and change the resource update. So that's coming over the summer, drilling, and then just production results, cash flow numbers. And look, I has a simple story because it's got no permitting issues. We are not waiting for permits. Won't be announcing an environmental permit. We have all of that. We don't have any construction update. We're built. We don't have any financing update. We're funded. We don't have any risk in country. I mean, for now, and we don't know any, but there's no risk in country. So it's a simple thing. It's a simple ship on the ocean, and we're going to cross the Atlantic and really arrive on the other side with very beautiful production, good cash flow, and we're buying ground in country. We're buying a lot of ground every month. Everything that we see that we like, we acquire from the government or from families, that we keep growing the portfolio, because we are on Fifth Avenue, and right now we're the only buyers, and we will keep buying.
Well, it sounds like you and your team are going to be very busy in the coming months. And once again, I want to thank you and safe travels.
Thank you very much. And please come over. The country's great. The food's fantastic. The weather, well, it does rain 3 days a year. So I'm trying not to come on for those 3 days. But otherwise, it's fantastic country to be in and to work. For after 25 years in West Africa, people say, "Are you looking anywhere else to buy this?" No, we're staying in Morocco. This is great.
Benoit, once again, thank you.
Thank you so much.
Shawn, thank you very much for joining us today. How are things in Vancouver?
Things are really good. It's a pleasure to be here. Thank you, James.
Thank you for the support. So Dolly Varden Silver is located in northwestern British Columbia in a region referred to as the Golden Triangle. It's a very prolific mining region. Why don't you just start with a brief overview of the company for those who might not be familiar with it?
Yeah, absolutely. So, yeah, like you said, Dolly Varden is located in the prolific Golden Triangle, an area that's one of the richest for silver and gold on the planet. It's got a rich mining history that exceeds the last century. Famous mines are Brucejack, which is owned and operated by Newmont. You've got the past-producing Eskay Creek deposit, which was operated by Barrick. And so where Dolly Varden sits in the triangle is we're at the southern end of the Golden Triangle. And what we were a company that had two past producing mines. The Dolly Varden silver mine, which was the richest silver mine in the British Empire when it was in production, and the Torbrit mine, which was Canada's third largest silver producer. The strategy that I've brought in, I've been running the company for 5 years. When I took over the company, we were a $20 million market cap. And what I've done is I've brought in capital. I've brought in a team that are regional experts, and we've made some accretive acquisitions. So today, the valuation of the company is $300 million. We've got a total of 7 deposits. We've got a very significant and strategic land position in the Golden Triangle, which includes a road to Tidewater. And there's some great infrastructure that surrounds the project. But really, this has been a company that has been highlighted because it is a rare company. Silver is scarce, and Dolly Varden represents about one of 15 silver opportunities, where you've got your 11 primary producers, and then you've got 4 companies that I've identified as plus $200 million market caps. And where Dolly Varden differentiates itself from its peers is not only do we have pure high-grade silver, but we have it in a safe jurisdiction. And so that's, we're in a great area. We've got treasury, we've got some great shareholders, and we've got a high-grade project in a safe jurisdiction.
And another related point that's very important is the permitting process. And maybe you can just speak to that and how the government of British Columbia is in terms of permitting.
Yeah, listen, BC permits mines at half the time that of the global average. So, we've got a permitting process that's approximately 3 years from beginning to end. And there's been a number of projects. Artemis's Blackwater project. I mentioned Skeena's Eskay Creek. And so there's been a number, Ascot's Premier. There's been a number of projects that in recent years have been permitted. So it's really, really simple in BC. If you respect water and you respect local communities, you get your permits in a timely manner.
So that's a good overview of the region. I want to move on now and focus more on your deposits. And when it comes to mining, size and scale is everything. And the Kitsault Valley Trend is 15 kilometers long with many separate and distinct deposits. Maybe you can just tell us what work has been done and what deposits you've been focused on in recent years.
Yeah, so you've really got to go back 100 years, actually more than 100 years, and look at how the region started. And what you need to appreciate is, there was a different type of explorer, prospector, miner that existed, around 1919. I was actually former U.S. President Herbert Hoover who opened the mine in 1919. But what you have to appreciate then is there was no hydroelectric power, there were no paved roads, there was no deep water seaport. You couldn't buzz around on a helicopter to remote areas, and really glaciers covered the area. So the area didn't see a lot of work. It was in a corner of the country that bordered Alaska. It was snow covered, and it's not like the Abitibi, Timmins, Red Lake, or a camp like some of the camps you see in Nevada. This is an area that, despite the 10 million year mineralizing event that brought in these incredible deposits like Brucejack, it's an area that's been really untouched until recent years. And so what my strategy was to go in and systematically consolidate a land package. And that's what we've done. We've taken some historic past producing deposits and we've augmented them with some neighboring deposits. I believe that what worked in the past in British Columbia will work in the future. So just south of our project, you have a site referred to as Antiochs. It was the site of a smelter. So back throughout the 1950s, when the Torbrit ore left Dolly, it would go down to Antiochs. And so my point here is the way the North operated in the past was as a hub and spoke model. And I think we're going to move back to that model. The Golden Triangle is filled with high-grade deposits. And my goal here is to create an opportunity where we've got a commanding land position with prospective ground, mixed in with some past producing high-grade deposits, also some 43101 compliant resources. And that vision, that strategy has led to share price appreciation. It's attracted some of the most notable investors in the space, including Eric Sprott, including Fidelity, including corporates who want the metal like Hecla. And we've seen the business grow from a $20 million valuation to over a $300 million valuation. We've been very, very supported, and we haven't had to do a down round in terms of, every financing we've done, 30 cents, 45, 70, $1, $1.25. And that's been on the back of accretive acquisitions, good shareholders, and most importantly, scientific breakthroughs that our discovery team has made.
And Shawn, you spoke about the market cap, how you took it from 20 million to 300 million. What about ounces and silver equivalent ounces? How much have they grown over that time period?
That's really why the growth has happened. It's not the doubling of the silver price from $16 to $30. It's been on the back of when I first came into Dolly, there was this idea that Dolly could never grow to 100 million ounces. And we now have, on a silver equivalent basis, about 140 million ounces silver EQ. And that doesn't include any base metals. So that's 50% silver and 50% gold. So on a metal basis, it's 65 times more silver than gold. We've got 64 million ounces of silver, and we've got 1 million ounces of gold. And that doesn't account for about 135,000 meters of drilling that has been done in recent years. And so those numbers may be understated.
And I'm sorry, did you say 135,000 meters?
Correct.
And what deposits have you been focused on? Where did you do all
So,
that?
yeah, and part of that drilling was de-risking drilling. We did in 2022, we did about 18,000 meters of infill drilling at Homestake to bring up our confidence in the inferred resource estimate, to show that there was continuity, there was grade, and we really have been very, very happy with the results that we've received from Homestake. So we focused on Homestake Main, Homestake Silver. We've done a lot of work at Torbrit, but the most exciting part of the Dolly has been the rediscovery of the Wolf deposit, which is primary silver. If you look at silver companies, 1 out of every 4 silver cos is primary silver. Most silver comes as a byproduct. So what Wolf represents is pure, high-grade, potentially bulk mineable silver. So Wolf has been an exciting area. And then the other meters have been allocated to regional exploration. So in addition to the 7 deposits, we believe that there is a periodicity, a repeating pattern, that every 1,400 meters, there's a break in that 15-kilometer trend that you identified, that north-south trend, that east-west, there are these cross-cutting structures that is bringing in mineralization. And so in 2024, we drilled a vein called Moose and a vein called Chance. And these are exactly 1,400 meters apart, and they're exactly 1,400 meters away from Torbrit, Wolf, and Wolf is exactly 1,400 meters away from Torbrit. So I think that it's not about what we have, it's about the potential to find a lot more. And that's why, we're about to launch it's a fully funded and it's a very robust drill program.
And before I ask you about the drill program, are you able to connect these deposits?
That's a great question.
Instead of having
Yeah.
like 2 or 3, is it able to be one large, massive deposit?
That's the idea. The idea is whether they're individual deposits and we employ that hub and spoke model, or if what our technical team believes, and if they're right, it could be pretty powerful. So what's happening is at the Wolf deposit, which started as a high-grade surface expression, as we started drilling it deeper and deeper and deeper, and what's interesting is no explorer in the past had ever looked at it because it sits below a sedimentary cover. So all the modern exploration tools like surface mag, geochem, it wouldn't penetrate the sediments. So we took a calculated risk, that the Jurassic Age Hazelton Formation persisted below the sediment cap. We drilled it and we hit. And what we found is as we went incrementally deeper, the veins would swell, and the grade would get more intense at depth. So that 300 gram per ton, which is a great grade for a silver deposit, 10-ounce silver is high grade. It starts to go 400, 500, 600 grams over 15, 20 meter wide intercepts. But what's exciting is a mile away, 1.4 kilometers away, you've got the Torbrit deposit, and it's the same dip, it's the same geometry, it's the same plunge. And if these two systems are coming together, and I've experienced in my 22-year career in exploration, when you have two systems coming together, you can get something pretty special in terms of grade and tonnage.
And we have drilling season coming up soon. What are your plans for the upcoming drilling season?
So we're finalizing those plans. I've got a news release that we're drafting that's going to detail the plans. But what we're looking at is an initial 35,000 meter drill program. Um, that 35,000 meters is looking to be allocated at Wolf, where we're looking to put out a new resource estimate. And the goals at Wolf are to infill the deposit. So we've had some ambitious, 200-meter step outs, 120-meter step outs. We want to infill those so that we can bring it into a compliant estimate. But we also want to continue to expand and extend the deposit, still open. And then we want to take some big step outs, 800-meter step outs in between Torbert and Wolf. So Wolf is going to see a lot of focus. And then up at Homestake, where we drilled 30 meters of 13-gram gold, 34-gram gold over 12 meters, 100 meters of 2-gram gold and 200-gram silver. We're going to also focus a big focus up at Homestake. So you've got a third going into Wolf, Homestake, and a third focused on more regional efforts at places like Moose and Chance that are showing a lot of promise.
You mentioned earlier that one of your shareholders is Hecla, and I'm curious, how did they get involved and how involved are they?
Hecla has been one of the most supportive shareholders that we've had. In 2023, they increased their stake in the company significantly with a large investment. They have become a 12% shareholder by investing capital in exchange for securities. They have an ancillary rights agreement, which allows them, as long as they stay above 10%, to maintain with a participation right. They have the right to a board member. So, I've got an incredible board of directors, which includes James Sabella, who is the former CFO of not only Hecla, but also Coeur. And so Jim is an incredible board member who is their representative. And then we've got a technical committee that is made up of a Hecla representative. So Rob Davidson is their rep. So as management finalizes the drill program, we present it to that technical committee, which includes Hecla. Hecla's got operating mines. They've got a long history, a century history of operating and producing high-grade silver. They're America's #1 silver producer. And so we get to leverage those technical expertise, and they get to chime in with their knowledge. And so they're quite involved.
I want to move on now and ask you about your balance sheet. Cash is the lifeblood of any exploration company. How much cash do you have on hand, and how will you allocate it in the coming year?
We've got 32.5 million Canadian dollars. And the idea here is we're leveraging 20 million of that into exploration. And so, we've had a history over the last 5 years of spending about 88% of the money we raise from our shareholders and putting it in the ground.
Shawn, you have said in the past that you want to make Dolly Varden a top 10 silver equity. Maybe you can tell us how you will do that.
Yeah, listen, when I came into Dolly, you couldn't recognize it from the 100 peers that it appeared to have had. And the strange thing that I saw when I looked at the company back in 2020 was it was trading at half the value of the peer group. So the peer group at the time was trading at 75 cents per ounce USD in the ground, and Dolly was trading at 37. So it was lagging the peers. It was, maybe 200 of 200 silver coats. And today, I would argue that it's top 15. Some could argue, even higher than that. And where I come up with that number is I talk about the 11 primary silver producers. I talk about the 4 companies that have plus $200 million valuations that are advanced explorer developers. And so I think we've positioned the company with that ascent from 20 million to over 300 million. We've positioned it as a top 15. My stated goal 5 years ago was to, number one, get to over 100 million ounces of silver equivalent. We accomplished that. The second goal was to make it a top 10 silver equity. We're not there yet. So I think if we continue to follow our plan, which is bring in high-grade inventory. Now, how do we do that? We can do that through discovery. We can do that through acquisition. I think if we continue to march forward and do that, Dolly Varden will become a top 10 silver co. And I've studied Pan American. I've studied First Majestic. I've studied Coeur and Hecla. And what these companies have had to do, because we've been in an environment where, the silver to gold ratio for decades now has been, really out of whack. They've had to be agnostic in the metal they're producing. And so what I'm really saying is most of the silver cos are not producing silver, right? There's a silver component to their production. So as I've studied how other silver cos have been built, and so what makes them silver cos? It's their mineral inventory, it's their reserves, it's elements of their deposit. So what I'd like to do, success for me, would be for Dolly, and specifically the Kitsault Valley, to be in a portfolio where it was in a pipeline of other assets. And whether we get there through one of the top 11 acquiring us, or we get there through becoming one ourselves, that's where I would like to see this project ultimately live. And, as a team, as a management, as shareholders, we're not going to stop until we accomplish that goal. And we've had a successful 5-year run, and we've done it at a time where it's been difficult. There's been volatility. I speak to you on a day where the silver to gold ratio is like 100 to 1. We have done, an incredible job, and I give all the value to the shareholders, to the scientists, to the board, to the financiers, and again, to the prospective nature of these rocks in the Golden Triangle, and ultimately the local communities who've allowed us to come in here and create jobs and to advance this project. And, the results speak for themselves.
Shawn, as we wrap up, you've already provided a lot of detail on what you and your team will be doing in the next few months, but maybe you can just summarize for investors on what sort of information they should be looking forward to in the next few months.
Well, it's interesting. We're pretty innovative. I believe that you have to be creative, and we recently put up on our website an IR chatbot. Now, we're all available. My number's there, my email's there, and I love talking to people, but not all prospective investors have the time or the desire to talk to management. So we created an IR chatbot. And if you were to go onto the site right now and say, what are the upcoming catalysts? The chatbot in seconds will tell you, number one, the company just announced its application to uplist on the NYSE American Exchange. The chatbot will tell you that the company is in the process of finalizing the drill plans to the 40,000 meter drill program that's fully funded. And so really the way I think if you're a prospective investor and if you've decided that you want exposure to silver and you appreciate that, silver, 50% of silver today is being consumed by industry, and you see that the shortages we've had for the last 4 years. And if you're wanting silver exposure, what Dolly Varden does is it gives you that in a safe jurisdiction. We've got a resource, we've got treasury, you're investing alongside some of the best shareholders on the planet, and we're going to go out and drive a lot of energy and catalysts and judge us on our 5-year history. There's a slide in our corporate presentation that summarizes that 5-year history, and you'll see a share price that's moved from the bottom left to the top right. But I think we're only a third of the way through that journey, and that's if we stop here. And we've got the desire and the ambition to keep growing.
Yeah, I love the chatbot idea. Can you tell how many people actually use it in the course of a day?
Yeah, and listen, we just put it up 10 days ago. We've already been into, and we haven't advertised it. We haven't, and we've already had, as of yesterday, about 500 meaningful interactions, 500 conversations. No, it's an incredible technology. And it's something that I think all companies should be using.
100%. And I love the idea that you have your name and your number up there on the website. 99.9% of CEOs do not do that, but you have your name and your contact information there. So you're making yourself totally available to shareholders and potential shareholders. So I applaud you for that. I want to thank you very much for spending time with us today and providing an update on Dolly Varden. Thank you.
Grateful to be on. Thank you, James.
Did you know that every time you hit the subscribe button, your name goes into a draw to win $1 million? I'm just kidding. But if you do subscribe, it really helps us build our channel. Thank you for subscribing, and thanks for your support. Maria, thank you very much for joining us today. You are the Senior Portfolio Manager and the Chief Investment Officer at Sprott Asset Management. So you're the perfect person to speak to about investing in precious metals. And I want to start with how you determine what names you invest in. What are the most important characteristics you look for in a gold or silver company?
Hi, well, and great to see you as well, Jimmy. Well, we have a whole process at Sprott about how we look at mining equities, be it silver or gold or in general, any mining equities. And number one, it starts with people. And we look for management teams who have done this before, who have run mines, who have discovered ore bodies. We also look for, deposits that will be ultimately mined, right? So for an exploration or development stage company, that means size, that means good metallurgy, it means a whole whack of different things and aspects of mining that we look at. So kind of people is number one, technical aspects is number two. The third one is we start looking at things like financials and capital structure of a company. Do they have cash? What are their funding needs? There's a lot of questions that we need to get answered. So finance would be bucket number three. And then kind of overlay that with the geopolitics and ESG factors. So, what is ESG? Well, that's environmental, social, and governance. And that's how does a company treat its people? How does a company treat the community surrounding their properties? How does the board of directors kind of interact with management and with shareholders? What are the policies of the company? There's so many different questions that we look at. So I don't think I can summarize it well in about a minute, but that's kind of the gist of it.
And as you mentioned, geopolitics is now more important than ever. And we've seen many examples in the past where mines, especially very successful mines, have become nationalized. So jurisdiction is very important. Are there countries you will not invest in? Or maybe the proper question is, are there countries that you prefer to invest in over other ones?
Certainly that is the case. And in fact, at Sprott, we have come up with a proprietary heat map. We have gone through kind of country by country as a team and ranked our preferences for countries. And that is kind of like the Fraser survey, but at Sprott, internal to us. And we published that on our website. There's certainly regions that if you think about stable regions, so think North America, Australia, those are definitely preferences for us. But we have gone into Africa, Latin America, we have gone into Europe. There's lots of places in the world that we go to, but you have to size positions accordingly. We are not, we're going to size a position in West Africa maybe differently than we would size a position in somebody who has mines in North America, for example. So it's all relative. There are places we also would not go to. I'm not going to name them, but certainly there are certain countries that we try to stay away from.
And what about market cap? You yourself, you focus on small caps and mid caps, but do you have any market cap restrictions?
Certainly our focus is, and our bread and butter has been small to mid caps. We don't really have, I would say we don't really restrict it by market cap. What we do look at is liquidity. In other words, how much does a stock trade every day? And of course that goes together with market cap. Normally size dictates liquidity oftentimes, but other factors dictate liquidity as well, such as sometimes a company will have large control positions of, when another company owns a stock or when an institution owns a stock. And so that's kind of a moving target. But certainly liquidity is something we take very seriously because we want to make sure that if we need to get out of a position, we can.
So once again, you're just trying to minimize your risk.
We're trying to make sure that even in downtimes that the portfolio has liquidity, that if need be, we can sell positions for sure.
And when it comes to valuation, how do you value a company, let's just say an Explorco or a developer versus a producer?
Yeah, and that's a very important distinction because you wouldn't value an explorer the same way you would a producer. And sometimes you can't even, it's very hard to value an explorer if somebody doesn't have ounces written down on paper. So that becomes an interesting exercise because then you're trying to think about what the potential there is, right? So what a company could find, how many ounces. And I don't think we have hard and fast rules for how we would value something like that. And in terms of, if you look at a production company, and we certainly look at various metrics, be it price to NAV, price to cash flow, free cash flow yields. We look a lot at ROIC, return on invested capital, and we actually have had many conversations with companies to ask them to start disclosing those numbers as well. So there's many different kind of valuation metrics we apply. There's not one and hard for everyone.
And part of the valuation process is determining what the proper gold or silver price is. What price do you use?
I generally use spot prices. What we find is the sell side analysts a lot of the time will not use spot prices. Frankly, they will not even use the forward curve. They will use some kind of assumptions that they've come up with, be it by the bank or whatever, by the brokerage. So we like to look at things at spot because we don't think that we're very good at forecasting metals prices. So we just say, today gold price is $3,000. Great. Let's take it and see what happens to valuations at that price.
And you mentioned that sell-side analysts will use a lower price, and so do corporates, and so do other buy-side investors. Why do you think they use a lower gold or silver price than what the spot price is at any given time?
Well, I'm not sure I have the answers to why they do that, but certainly it becomes quite punitive, and it has been in recent years. As you know, both gold price and silver price have risen in recent years quite a bit, but the forecasts have not kept up, even with spot prices. And even now, like I said, we're sitting at $3,000 gold, and I think consensus estimates are much lower than that. So it becomes very punitive for the companies when you don't apply spot. So as to why, I'm not sure. I know why the corporates use lower prices, and that's probably because they need to run budgets. They need to think of, maybe protection on the downside. So that's kind of a more risk averse take on the whole thing. So I understand why a company would do that, but I'm not certain why sell side analysts and financial players would use lower prices.
And as we both know, there's hundreds of different gold and silver companies out there, maybe thousands, but how many names do you and your team cover, and how many do you have in your portfolios?
Well, we certainly, our team definitely comes across a lot of companies, and we take a lot of meetings with companies to just, if it's a smaller company, we just want to start tracking it from an early stage. So I would say it's in the hundreds for sure. And again, a lot of, when you say tracking, I mean, it doesn't mean we're really tracking the company month to month, quarter by quarter, but we kind of take a lot of introductory meetings just to see if there's something interesting there.
And how many names would you have in your portfolio?
Oh, well, so yeah, so when it comes to actually structuring portfolio, we try to be more focused. We have certain portfolios that are about 30 to 40 names, and we have some portfolios that are even more focused than that, let's say around 20 names.
And once again, I want to go back to valuation, or where a lot of gold and silver names are trading right now, especially when you compare it to the spot price. They're trading at deep discounts, and in some cases with many different producers, they're trading at deep discounts to their NAVs. Why do you think that is?
That's an excellent question. And I think it goes back, partly the answer goes back to that disconnect between what's happening in the price of the metals themselves and expectations of people going forward. And again, going back to the sell side analyst comment, they usually expect the price of gold to decline or the price of silver to decline, and that obviously affects NAV and affects your forward multiples. So that's punitive. And I also think that there hasn't been a generalist buy-in to the sector, and the belief that these companies can generate lots of cash flow, etc. What we're seeing now in 2025 is that because the prices of the metals have appreciated, these companies are really generating a lot of money. And I think going forward, we're going to see that even more so, right? Again, I think there's just been a disconnect with how fast the metals prices have moved and that cash flow generation. I think it's going to be very interesting to see what happens with the mining equities.
So I want to ask you a silver specific question now. We have gold trading at or near all-time highs, but silver is nowhere near the all-time high that we saw back in 2011, which was $50 an ounce. Why do you think silver is still trading at a big discount to its previous high? And especially in terms of, or when you look at the supply and demand economics associated with silver. We keep hearing that demand increases, it keeps increasing, but the supply is stagnant or decreasing.
Right. And I speak to the supply demand deficit in silver a lot. I think, as you know, silver has kind of two heads. It has the monetary head and the industrial head. And yes, the industrial demand has been growing and fast and in large quantities. But what silver doesn't have is the buy-in from central banks. As you know, gold has been gobbled up in the last 3 years by central banks, over 1,000 tons a year per year. Silver hasn't had that. Central banks have not been known to accumulate silver. Oh, sorry, silver does not have that. Silver is not being accumulated by central banks. So I think that kind of has hurt silver. Also, I think if people are expecting a slowdown in the economy, specifically because of all the tariffs that are being announced, the perception would be to hurt silver as well, because it is used in industry. I would say my pushback on that argument would be that silver is used in many different uses, but in small quantities, and B, it's used in energy transition type, green type kind of uses. So for example, solar is a way for humans to try to transition towards cleaner energy. Electric vehicles, again, it's something that we've tried to push forward in order to have cleaner energy and cleaner environment. So those things, unless there's a big reversal in those trends, and I think those trends are secular, they're longer term in nature, I think silver should be insulated from downturns in the mass economy, right? So anything to do with electrification, if we continue pushing towards electrification of the world, silver will directly benefit from it, right? Another area would be artificial intelligence or AI, where, again, silver is used many, many times over, but in very tiny quantities. So we'll see what happens. It has been frustrating to watch the silver price, to your point. But, I think that sooner or later, that supply demand deficit will catch up to the price. And what's happened recently in the last couple of years, and I talk about that a lot as well, is that inventories in London, COMEX, and Shanghai, if you look at those above ground inventories of silver, they have declined, and they've declined by close to 500 million ounces, if I'm not mistaken. That's a very large amount. So again, these supply demand deficits should be translating to eating through these inventories over time. And as that happens, I'm hoping that that will again translate to a higher silver price.
Yes, I keep hearing, this bullish narrative for silver, but I just don't see the corresponding move in the silver price. But I think you raised a very good point in that silver might be more like copper and that it's a reflection of what's happening in the economy.
Well, yes, it's the perception that if the economy slows, then demand for silver will slow. But we are sitting at about 150 to 200 million shortage of silver a year, and this is a market where we only produce 1 billion ounces a year. So think about that. That's between 10 and 20% of supply we're short every year now. That's a lot of ounces to find. And what I have seen over the last 10 years, I've been tracking this market over 10 years. Over the last 10 years, we have not increased silver production in the very least. In fact, if anything, we have lost about 50 million ounces per year of production. And there's various factors there that are playing a role. There's been a lack of exploration and development in the silver market. Reserve grades and production grades have been declining, so we have to find bigger ore bodies that are lower grade. We have to invest more money into infrastructure to develop these deposits, and that's just led, like I said, to actually a stagnant to declining production profile. And it's interesting because every year I see forecasts for an increase in mine production, but we're just not seeing it to the extent that people are forecasting because something always happens. A mine could have operational issues. You mentioned earlier, sometimes a mine is shut down because of various issues. Something always happens in mining where supply can't keep up with the projections that are out there. So yeah, that's, longer term, I don't see a scenario where silver price is lower. The fundamentals of the market are just very into silver's favor right now.
And I want to ask you about the deal pipeline right now. How would you describe the deal market? Are you seeing a lot of deals, and the deals you do see, are they able to raise 25, 50, 100 million bucks in the current environment?
We're certainly seeing financings, happen. And if it's a good deal, I always say good deals will find the money. Good deals have been oversubscribed by a factor of 2-3 times. So there's money out there, but I think it's money that is smart money, and it wants good deals. It wants good deposits, good mines. So yeah, we are seeing that, and it is encouraging for sure.
And before we wrap it up, Maria, I want to ask you about one of your mentors, and you had the privilege of being trained by one of the greatest investors in the precious metal space, and that's Eric Sprott. I'm curious, what were the number 1 or 2 things you learned from working with Eric?
I don't know if I can summarize it into 1 or 2. Eric is definitely a great man. He hired me 20 years ago. But I will say a couple of things. So number 1, Eric always looks at the big picture. He always wants to see how big something will get, Another important thing is grade. And as you know, grade measures how rich a mining deposit is. So those kind of 2 things are very important. And the other thing is he taught me a lot about macro and looking at macroeconomics, looking at what's happening in the world, trying to learn and understand what's driving, the price of gold, the price of silver, because these are very macro-driven things, the metals. So, and that gave me a love at looking and reading about macroeconomics, just again, exploring the world and learning about the world. There's
Interesting.
lots more, but I don't think we need a lot of time to cover everything.
No, you're right. Talking about macro is very important now, especially more than ever. You got to look at the US dollar, interest rates, inflation expectations, what's happening in other countries, and where the money's flowing to. Well, that was a great discussion, Maria, and I want to thank you very much for spending time with us today. If someone would like to learn more about Sprott and its various gold and silver products, where can they go?
Very simple. We have a website. It's great. It's www.sprott.com. And, I will say that our website is tremendous. We have a bunch of people writing articles. So we have a whole section, at least one section of the website dedicated just to all the articles and webcasts and podcasts that we do. A lot of information on various metals, not just gold and silver. It's a great resource. Highly recommend it.
Maria, once again, thank you.
Thank you.
Hi, Brad. Thank you very much for joining us today. How are things in Mexico?
They're good. They're good. They're heating up, getting warmer down here now. So been here a couple weeks visiting both operations, Boral and our Jalisco development project.
So let's talk about your various operations. GoGold has two flagship properties in Los Ricos South and Los Ricos North. And when in full production, GoGold will go from 2 million ounces a year to over 15 million ounces a year in silver equivalent. And I want to examine each deposit and how they will contribute to the growth of the company. And given that Los Ricos South is the most advanced, why don't we just start right here? You and your team completed a feasibility study on this. Why don't you take us through it and give us the highlights?
Yes, in Los Ricos South, it is the most advanced part of the development in the district. And Los Ricos South, for that we have a front-end engineering design. So really we're shovel ready to go with a permit. $23.50 gold and $26 silver at 358 million NPV and internal rate of return just under 30%. At current spot prices in Los Ricos South, and of course it's a very new study, so it has a sensitivity published in the report, but current gold and silver prices, it would be closer to about 650 million of NPV. Now, the first 5 years, it'll produce a little over 7 million ounces, and the average of the first 10 years will be about 6 million ounces of silver equivalent. Really important also is that the all-in sustaining cost is low at about $12 per silver equivalent ounce. So that's Los Ricos South, and then of course we have Los Ricos North as well, which is at an earlier stage study. It's at a PEA, and that study's a couple of years old. When we published at $18.50 gold and about $23 silver, it was 413 million NPV. At current prices, it would be about 850, but I would say we deduct about 100 million off there for increase in costs, so about 750 million NPV. And for a district-wide, around 1.4 to approximately 1.4 to 1.5 million NPV. Sorry, billion, 1.5 billion NPV.
And a big part of the GoGold story moving forward is receiving the permits for Los Ricos South. How's that progressing right now?
It's going well. We've been in the process for the last 2 years. And I'll tell you that I've been in Mexico now for 28 years, myself and team, building mines. Really, Los Ricos South will be mine number 5, and Los Ricos North, when we get to it, mine number 6. So in the past, a typical permitting process for us down here was 6 months. It's been 2 years. And I would say it's not so much that the technical process has changed. It's more that it was a bit of a political issue. In the last administration, they made some changes to the mining laws, and one of the changes is that they said there would be a prohibition on open pits, and really they just slowed down the whole permitting process because of that. Now, the same party won in the election last June. And the new president, Claudia Sheinbaum, took office at the 1st of October. And really, she has softened that approach. And, for example, I had a meeting, GoGold and 10 other companies with their Secretary of Economy's office and the Environmental Authority in November, and they laid out their plan. The new administration made it very clear that they will pass president's prohibition on open pits. They're demonstrating that they're very much more mine friendly, and she has stated, their administration has stated that they do understand that mining is very important to the Mexican economy. So back to wind permits, our best estimate is the next 30 to 90 days. We should have a permit. It could come at any time now. The technical process is complete, and it's just a final review and a signature on a permit. And that'll be the underground permit for Los Ricos South.
And once you receive the permits, then what? What are the next steps?
The next steps are we're ready to go. We'll start on some of the surface infrastructure. In fact, we're so certain we're going to get a permit that we've already started on some of it that we can do without a permit, and that's a power line. We're building a 36-kilometer power line from the Ayesca Dam, which is a hydro dam, to supply our power, and that we have a contract with the national utility to build that power line for us, and they've reserved for us contractually 15 megawatts of power. So that's all the power that we need, and that would be built on existing right-of-ways as well. So a project that will take between 18 and 24 months to complete. So we've started that project in anticipation of that permit. The good thing is that we're currently have $135 million US dollars in the bank account. So no debt, very strong balance sheet. We're generating $4 to $5 million a quarter at our Peral operation of free cash flow. So that's paying for all of our G&A and funding some of the exploration and engineering work we're doing right now. So we can get going on this. We're shovel ready. We can get going. We have the capital in the bank. We don't have 227 million today, but we have 135 million equity portion, and we're well down the road in securing the debt portion to get up to that over 227 million of available capital to build the project.
And from a valuation point of view, let's just say if you receive your permits tomorrow, what would that mean to the valuation of GoGold?
Really, that's probably going to be one of the biggest catalysts that the company will have seen. There's definitely a discount on the Mexican national miners and the foreigners on projects because of kind of frustration. A lot of it. Some of that's come off here with the statements recently by the new administration. But we do believe that it's still a very large catalyst for the company. And with permit, there should be a real re-rating. And it will have taken a lot of the risk out. And especially for GoGold, it's really taken not all the risk. There's always risk. But I'm saying it's taken the permitting risk will be gone. Financing risk, I would say, is as close to zero as can get. We have a very strong balance sheet, and we have 8 term sheets that we're going through. So financing risk, the project is extremely low for us. The engineering study is a very advanced full feasibility with front-end engineering design. So really the permit is the last kind of holdout before I believe all the institutions that aren't in will be looking at GoGold once that permit's in hand.
So you touched on Pearl Perel a couple of times, and you've been self-funding from the tailings at Perel, which is a great strategy. But you said there's 4 years of life remaining there. What are you going to do with it once it's complete?
Yeah, there are some other potential tailing piles that we're looking at within trucking distance. And we do also have our Esmeralda tailings, which have drilled, and we have a resource around those, which would represent another year and a half. So we think we can probably keep it going more than 4 years before we would reclaim the project. The project, and yes, you mentioned about helping us self-fund what we've been doing here. It's been great for that, and it's also been a real good project as far as social responsibility, as far as social license. It's really a environmental cleanup that has made the company money, has employed people in the community, and has cleaned up the environment. So the Environmental Authority in Mexico really is interested in that project. They like it. That's part of their agenda, is that they have 500 tailing sites in Mexico that they're looking for solutions on. So, that has really opened the door for GoGold as far as a relationship with this administration and the Environmental Authority. So this is new technology that really we've developed and perfected over the last 11 years. And when I say new technology, I mean, there's agglomerated heap leaches in the world, that's for sure. I think this is the first one I know of at this kind of scale where agglomerated heap leached old tailings for gold and silver. And, there was some bumps at the first of the road, in this project, because we're the first, cutting edge, maybe was a little bit leading edge for a while. But we worked that all out, and the team there has become real experts at doing that. So there may be other opportunities for what we've developed there and to continue longer with that operation. And maybe it will apply to some other environmental cleanups of tailings in Mexico as well. Yeah,
an additional 500 mines could keep you busy for a few years.
Yeah, you could really make a business out of that. And, it's good. It's a good project as far as building on our social license and environmental ESG. It's great for that.
And I just want to summarize the production profile. So right now at Perel, that's 2 million ounces. And then when you start production at Los Ricos South, that's going to bring you up to 9 million. And then when you bring on Los Ricos North, that'll take you up to 15 million ounces of silver equivalent. Is that right?
Yeah, in that range. Now, we're also doing some really exciting exploration outside of our reserves and outside of our resources, actually, in Los Ricos South. And, there's a deeper horizon that the former operators, about 100 years ago, at the end of the time that they were there, they discovered this deeper horizon. And that was in 1927. In 1930, most of the foreign companies left because of political situation in Mexico at the time. But they had found that for us. So we've now turned our drills to exploring that second deeper horizon, which would be about 700 meters below surface. And also, there was a missing, faulted off section of the structure to the south of where we have our reserves. I mean, right to the south, within 100 meters, they lost the vein. And there, on the north side of that fault, one of the holes that we drilled closest to the fault was about 21 meters of 2 kilos. And then south of that fault, they could not find, nor initially did we find, the missing piece of vein for about 500 meters. So recently, we've been drilling there as well. And we have drilled into that and found that missing piece of structure. And we are waiting for assay results. So we're encouraged by that as well. So the long and short, I think there will be a lot more exploration upside in Los Ricos South. And really, the whole district is, I think it will develop into a real camp because there's so many other targets to drill and explore in the Los Ricos district. And, we really didn't stop drilling because we weren't hitting. I mean, one of the last holes we drilled, and which is within our current reserves, was 55 meters at 2.7 kilos. I mean, we were just hitting some remarkable things. That being said, we entered the project 6 years ago. We have a large institutional support, about 50% institutional. Every 2-3 weeks, we're putting out press releases with kilos of silver in drill holes. After a while, people say, what does this all mean? Tell us what's the path to production? How's this going to pan out when you do all your economics around it? So we moved to that phase. And now I think it's going to be really, really exciting as we drill very near to the mine that we're building. Because, of course, you can imagine what kind of impact finding new resources and reserves next to an ore body where you're already going to spend that $227 million of capital, and how it would affect the NPV.
And when can we expect results from the assays?
I would think we'll have our first results out in a month to 6 weeks, as we put together, some discovery drill holes and, some more holes around those to show that, it's holding together.
So you have a lot going on. That's going to require a lot of capital. So why don't we talk about your balance sheet now? You just did a raise recently. Why don't you take us through that? How much did you raise? What was the demand like?
Well, the demand was really good. We were offered money several times before that, but at lower prices, and we said no. But we saw an opportunity, and we were, an opportunity not just to raise the capital, but to bring in some new shareholders. And we looked at it and said, well, there has been some re-rating in the stock with the commodity price increase and with the tone in Mexico being very good now. And we said, why don't we raise? We'll be able to get that 75 million. There's big demand for it. And we're bringing some real, good new shareholders, and they'll have exposure still to some of the catalysts going forward of that permit. And, our current shareholders, we thought strengthening the balance sheet did something else for us. What it did was give us the flexibility so that while we're building the mine in the south, we can continue with the north and we can do exploration. Sure, we could have went out and got all the additional capital in debt, but then we're going to be a little more covenant heavy, and it'd be much more restrictive on exploration and advancing the north while we're building the south. So that was the thought process in raising the money. The demand was very, very good. We filled the green shoe, so $86 million in total funds raised.
I want to ask about M&A because we've seen some activity in the silver space recently with Core acquiring Silvercrest and First Majestic acquired Gatos Silver. Can you just speak to those valuations and what you think this might mean for GoGold at some point in the future? Yeah,
general, I think consensus on those two deals would be that the Silvercrest deals are around a 1.7 multiple to net asset value. And I believe Gatos was even a little bit higher at about 2 times net asset value. So, there's 2 ways we can increase the value of our company. One is by getting a better multiple to our net asset value. And, currently we're probably around a 0.4 consensus of our analysts. But, as we build, as we break ground, get the permit, that's going to be a real big catalyst. We should move up on that multiple to net asset value. And then as we get to first pour, another bump up, and then full commercial production, we should really win that kind of net asset value. Now, there's another way to increase value. Obviously, the other way is by, 2 other ways. One of them's out of our control, but it's helping us, and that's commodity price. And of course, your net asset value is increasing with the commodity price. The other is exploration potential. If we can increase net asset value by drilling more ounces, which I strongly feel there's a good opportunity there for us, especially around Los Ricos South, to add some more ounces near to real brownfield, near to what we're building. That will increase net asset value. So 2 factors. 1, move it along the development path, get it built, make gold and silver. That's going to increase the multiple to net asset value. 2nd, commodity price, and find more ounces around what we're building. That's going to increase the net asset value and increase the multiple and increase the value. That's the way we raise the value of GoGold. And I think it's looking pretty bright, the road ahead of us to do that.
Well, Brad, that was a great overview of GoGold, and I want to thank you very much for spending time with us today and sharing the story. And as we wrap up, you've already gone through a lot of detail, but maybe you can just summarize for viewers on what they can expect in terms of news flow in the coming months from GoGold.
I think really the number one catalyst is that permit, and I think that's near term. That'll be a big catalyst. The next to that will be that we're breaking ground, and that'll come very soon after the permit, almost immediately. The next catalyst will be, depending when the permit comes, but will be that exploration that we're doing around Los Ricos South. I'm a geologist by education. I can tell you I'm very, very excited about what I'm seeing, and very excited about the anticipation is building on what those assays will be like for myself and the team on those new drill holes that we're drilling.
Well, once again, Brad, thank you very much, and I look forward to seeing the results here in the coming months.
Great, thank you.
Michael, thank you very much for joining us today. How are things in Colorado?
Oh, nice. Spring is coming.
So every day is like walking through a financial landmine. And what I try to do in markets like this is take more of a defensive approach. I'm trying to protect my money as opposed to make money. And so I'm hoping you can help me with that process. And I want to go through various asset classes. And the first one I want to look at is the S&P. We peaked out earlier this year at 6,100. It went all the way down to 4,800. We had a nice rebound up to the 5,400 level. Now it looks like it's under pressure again. So I want to start right here with the S&P. What's your view on the S&P?
Our view on the U.S. stock market, we look at the S&P 500 and the NASDAQ 100 because the NASDAQ 100 is the leader index. Its front-end loaded symbols are basically the symbols that everybody chatters about, the Mag 7 type thing. And it led the way up. It morphed since you go back to 2009 bear low. The NASDAQ 100 went up like 18, 19-fold, whereas the S&P went up 9-fold. So, NASDAQ 100 vastly beat the S&P. And it will do the same on the downside. When we're now, as far as we're concerned, we're in a bear trend. That first drop, back in January, when we were, in fact, just before we made the high, which is, like you said, over 6,100, a couple of weeks before that, we said, that's it. It's no good. Well, it went up and made a new teasing high, didn't go anywhere, and then started to wobble down. But the NASDAQ didn't break our momentum trend structures. We're not you look at a price chart if you want to. It's usually lagged to momentum. But momentum trend structure broke to the negative direction in early January for the S&P. But it took till late March, mid to late March, for the NASDAQ to do the same. And we wanted it to break because it's the leader. And it broke, like 20,000 to 21,000 zone. Okay. And it's since dropped down to 16,500. Just like the S&P dropped down close to 4,800. Well, when that break started, we did some game playing with the price charts, which anybody could with a crayon. You go back and look at what was the high for NASDAQ and S&P at that last major high. For NASDAQ, it was in November of 2021. For the S&P, it was in January 2022. You draw a line across that high. Where was it for the S&P? 4,800 plus. came down and sat on it and been bounced. Why? Because people could draw a crayon line and buy it there, thinking, oh boy, support. Okay, fine. And NASDAQ 100, its level was about 16,500. Where did it bounce from? 16,500. So not just that, we had some momentum reasons to assume there could be a bounce because we were short-term, not long-term, short-term oversold. So sure enough, we got our bounce. In fact, if you'll get a daily chart out of the S&P, if your viewers will, and go back and look at the low that hit that 4,800 on the S&P, 16,500 on the NASDAQ. The rally that followed, I think went to the 90-day thing, but that was the rally. In fact, when you made your high shortly after that day ended, I think the next morning or something, you never took it out again. The rally was literally one big, huge headline chasing day. And since then, both indices have been stuck below that high, trying to get above it, couldn't do it. Now they're coming back to challenge that low. And we argue if you take the S&P back below that 4,800 by any credible amount, and you take NASDAQ below that 16,500 by any credible amount, then that's when the price folks will start to pull their hair out, say, oh my gosh, support didn't hold. Well, it's idiot support because, again, any kid with a crayon could draw a line across that. Momentum, meanwhile, is broken. It's that little bounce point we expected. They got it. It's hopeful. But the key for the stock market, I think, is not the stock market, is underlying macro fundamentals and technicals that are going on elsewhere. One of them is the dollar. The dollar between 2022 and 23 and into 24 did nothing. If you look at the price chart of the dollar index, it was stuck in about a 7% range, up, down, up. In other words, nowhere land. Therefore, the euro and the yen were in the same kind of sort of nowhere land, because that's what comprises the dollar index. 71% of it is those two. But it was really non-event. So the foreign exchange markets, the big foreign exchange, was not a factor. It wasn't caught making noise. It was the quiet one. We call it, watch out for the quiet one. Okay. The end of March, the dollar index broke under 104 something. And on the price chart, that didn't mean much because the prior lows during 2022, 2023 were all at 100 level. Okay, price chart lows. But annual momentum broke a trend structure at 104, just above 104 at the end of March. Now, 6% drop in 3 weeks. We traded under 98 today. We're at another trigger level for it based on 10-year average momentum. And we've got that chart we can show. And when you look at that chart, you can see, again, the 3-year average oscillator, which is also annual momentum, it already broke. Okay, now we're looking at a 10-year. And if you look back, you can see that zero line on that momentum chart, which goes back to the low that occurred in momentum low I'm talking about, back in that 2021, back in 2018-19. You use the 10-year average as support. There was the momentum bounced off that zero line, says, oh, I got support there, okay? And then you can see by looking at that bottom chart, which is the momentum chart, where you plot each month's close, the dollar index, where is it in relationship to the 10-year average? Is it above it or is it below? So you plot an oscillator. We've traded below that zero line today. The zero line meaning 10-year average, 98.35. We traded down into the 97s. Now, if you close the month out below that 98.35, you've blown the last vestige of support that exists for that currency. There's an open window now to drop another full 20 points just to get back to the lows that occurred 12 years ago, near 70. And I frankly think that's about what's going to happen. That becomes a huge impact creator, wave creator in other markets, which for the prior 2 years wasn't. It was quiet. And then when you go to the T-bonds, this is where it gets really scary, especially for Powell and his gang. They can ignore all kinds of stuff if they want to. Stock market drop, okay, we can ignore that. They can't ignore bad data points. but the data points haven't been bad. And the reason is, if you go back and look at any bull market peak in the stock market, it takes until you demonstrably into the bear trend before then those data points start going negative in a way that smacks the Fed in the face. But that bond market is a variable that is behaving incorrectly. Okay. In fact, it crashed. We had a rally high about 3 or 4 weeks ago up to 122 on the long-term T-bond futures, 30-year bonds. They collapsed within 2 days down to 111. That's it for the T-bonds. That's a crash. That woke up the Fed, even though they can't admit it. You cannot have government debt go into that type of behavior. So they're fully aware of that. But their problem now is tells them you got to cut rates. And so if they cut rates, they look like, well, who's in charge here? Okay. So, but they know with the T-bond market imploding, and it's now coming back down it got into the 112s again today. They had a little bounce, just like the stock market did, off that puke low of 3 weeks ago. And just like the stock market had a little bounce, but now it's starting to weaken too. So that's really the market that would panic central banks the most, especially the U.S. central bank, government debt. So those are two variables that will impact that stock market.
Okay, I just want to ask you one more question about the S&P. That last level we saw was 4,800. Do you think we test that in the coming days? And if so, do we go through it? And if we do go through it, what's the next level on the S&P?
I think we're in a major bear trend. I think it's begun. But when you start a bear trend, it's not always just one magic signal from a price structure, or in our case, a long-term momentum structure being broken. It's layered. Go back and look 2000, 2002. I mean, it wasn't A to Z. It was zigzags all the way. In fact, the Fed cut rates all the way down. Didn't stop the market. Or 2007 to 2009. There were many lovely rallies. Fed even did rate cuts all the way down. In fact, they did rate cuts 1 month before it peaked. Okay. That didn't help the market. It helped gold because they're creating money, okay, printing money. But so don't look for, one thing to cause a total implosion. Instead, we break enough structure to where we say momentum says you're broken. Price will then, within a few months, usually finally agree in a way that average Joe can look at a price chart and say, uh-oh, something's broken here. Momentum leads. There is a level below the 4,800 on annual momentum of the S&P. It's only about 3% below there. And I won't get specific. We do with our subscribers. That you break that and all hell could break loose. I don't mean necessarily a crash, which is 30% or 35% in a week or two. But that's when the public is going to realize that, my God, it's not a bargain. It's not a corrective 20% pullback. It's a buy. Instead, something else is going on here. And I suspect when that occurs, the S&P breaks through 4,800 and goes the next 3 or 4%, and then blows the bottom out of another structure. That at that point, you'll look over at the bonds and say, oh, I can understand why. Or look at the dollar, I can understand why. So all these things will coalesce. But yeah, breaking 4,800 is a big deal. Not just because you break that idiot line on the price chart where people bought and made, as I said, one good day of rally and the rest has been below there. But at that point, the public starts to scratch their head and get really worried. I mean, after all, you've already taken away in that drop to 4,800 all of 2024, and you're back to the highs of 2022 in the S&P, meaning 23, 24 was a waste of time. You're back where you were in January of 2022. That's a lot of time wasted to be back at the same level you were from an investment point of view. And for NASDAQ, you're back to the high that occurred in 2021, excuse me. So it's a wipeout that causes a lot of sadness. People with 401ks, oh boy, I got enough to retire, dear. And all of a sudden you just give up 20%. Then you give up 30. My God, your life has changed. So real panic sets in. Those data points will go south in a big way, real fast. And I suspect they'll start showing up in a month or two because of already what's happened. And that's when the Fed will have to give in and look, and unfortunately for them, it's going to look like they did give in.
Well, I might suggest it might even happen sooner because
Yep.
we have Q1 numbers coming out now. We've already had profit warnings from a lot of companies.
Yeah.
Walmart came out and cut their guidance for the year. D.R. Horton, the largest home builder in the U.S., took down their guidance. We've had every major airline cut their guidance. Delta, American Southwest all said both business travelers and also pleasure travelers are not flying because of the uncertainty with this current environment.
Mhm.
And I thought this one was interesting. LVMH, the high-end luxury retailer, also came out and said they expect weaker numbers going forward.
Mhm.
In Asia, their numbers were down. The revenue numbers were down 11%. In the US, they were down 3%. So not even the rich are spending money now. They're starting to feel some economic pain.
Sure. I mean, when you're uncertain, what do you cut? Discretionary spending. And this is one thing I hear about Apple all the time, or I don't hear about Apple. And that is, oh, the concern is, well, the relations with China, and therefore, they need to produce there, it's cheaper, and so forth and so on. And nobody's talking about the possibility that suddenly parents won't be buying their teenage daughter a new cell phone every year or upgrading every year because Apple introduces new features. They're going to say, I'm sorry, dear, you keep the one you had 3 years ago. We're not going to update for a couple of years. It's unnecessary discretionary spending. That's what could kick like a company like Apple, which nobody's talking about that variable. In other words, the collapse in discretionary spending, which among middle class has probably happened to full extent as possible, and even among the rich. They're saying, hey, dear, let's just cut back. We're a little uncertain here. And they can go down quickly too. Just because you're rich doesn't mean you can't collapse quickly, especially when you're fully exposed to the stock market or your company's fully exposed to consumer demand. So it's a rapid trigger. You're quite right. It could happen pretty quickly. And I wouldn't be surprised you start to see the numbers coming up, next month. And then again, what does Powell do? Well, at least he's got an excuse then and has to say, well, I'm doing it because of this, not because you're telling me to. Anyway.
Now, the last time we spoke, you were very concerned about the banks, the US banks. And here in the last few days, we saw a lot of the major banks report their numbers. JP Morgan, Morgan Stanley,
Yeah.
Goldman Sachs. On the trading side, they all reported record numbers because of the volatility that's going on in the equity markets and the other financial markets. They're making a killing from all the trading. But are you still concerned about these banks?
Yeah, because they're secondary. They're not a leader, meaning what's going to impact them are things that you just talked about. Companies outside the financial arena who have debt, they're the lenders. So, it's not them as such. It's what goes on elsewhere. Like we're watching commercial real estate in particular, because we know it's a heavily debt-laden sector. And that sector looks technically very weak and vulnerable. In fact, if you go back to 2016, punch up a chart of RWR or VNQ, these are ETFs of commercial real estate, been kissing your sister for all those years. Whereas either side of 100 on RWR, up and down and up and down. And when the market went up and made new highs, taking out the 2022 highs in 2024, S&P, NASDAQ, they didn't. They only got halfway back to their high. So they were very anemic, for obvious reasons. And now they're quite weak again. It's that sector, you start to have this company, that company, et cetera, within commercial real estate suddenly default on debt. And we had a story a week ago, one of the biggest shopping center companies in the country in New York. Forget the name of the company, it doesn't matter. $300 million default. Somebody's eating that. But all you need is like 2-3 more of those. And suddenly people say, gee, this is a contagion. Well, it's a contagion because of all the things that are going on, that domino, and ultimately they'll domino into the banking sector. Also look at the bank sector just on what happened in that collapse we had 3 weeks ago or so. S&P low, NASDAQ low. Go look at the bank low, KBE ETF for the banks, and look how anemic the rally's been. It was nowhere like the S&P bounce, the NASDAQ bounce. It was very anemic. Yeah, it rallied, but it was anemic. And right now you're trading about 1.5 last I saw, above touching the low you traded on the KBE, which is down around I think 95 or something. I think it's trading 96, high 96s today. So it doesn't look too good. It bounced with the market, but it's very anemic bounce. And it was, I think, down less than the market today, but still it's very close to its lows. So again, all these things factor in together, and the causative factors are, not really a stock. It's the business that we're talking about, consumer discretionary spending collapsing. If that continues, that's disastrous. Also, that affects what? No doubt commercial real estate, shopping centers, etc. And any company planning to expand its business facilities and using commercial real estate company to do so, to create an office complex that's tech-savvy office complex. There's companies that do that are computerized centers and so forth. But so it's all kinds of dominoes here.
Yeah, to your point earlier, there's a lot of layers to peel back. So I just want to summarize a few of the points you've made. Okay, so first of all, with regard to the S&P, we get up to that 5,400 level. We've been pulling back. You're very concerned about the 4,800 level. You think we can go through it. In terms of bonds, you're very concerned here. I think you said the level on bonds is 112.
Well, you get down in a report we did for our subscribers a week ago. We defined some levels that we're not back down to, but those levels that we saw in that break. Just look at a price chart of T-bond futures. We do ETFs of TLT, for example, the 20-year bond ETF, and go back and look at that low. You don't want to go back to that low again, because next time you go there, you're going to break some stuff that isn't just the price low. You even get near that low, you're going to be breaking some momentum stuff that says, that bounce didn't hold. It was just an oversold bounce. And that's the kind of market that the Fed really cares about. I mean, they could turn their nose up at NVIDIA, but you start breaking the U.S. government debt market, that's when they go into panic mode. Well, I mean, what's the chief beneficiary over the decades when the central banks go ape and push the pedal to the floor, either through lower rates than market would otherwise have, expanding the money supplies, doing QEs, gold, and monetary metals. And so if you look at today, even though silver was up less than gold, all the monetary metals were up, the miners were up, very little else was up, period. How come they were up? They're supposed to go down with the stock market, we've been told, remember? Okay, it's not true. Okay, anyway, so I think investors are just now beginning to realize that hey, gold, and now suddenly you go to the financial TV channels, they're actually talking about it every day. Used to be they'd hardly ever talk about it.
So you mentioned the Fed a couple of times, and I just want to have a deeper discussion on this. And Jay Powell has expressed a lot of concern around the uncertainty associated with tariffs. And he said he doesn't know what to do. Yeah. Now, the president has not taken too kindly to this. And
one accusing the other, not cutting the other, said, you're causing this with your tariffs. Yeah, it's back. I love it.
So the president's rhetoric is really starting to heat up. And in fact, he calls Jay Powell Mr. Too Late. And he also referred to him as a major loser. I'm sure that's the first time in the history of the United States that the president spoke that way to the chair of the Fed. But what do you think Jay Powell does? You mentioned earlier he's already
it could be that argument there could be a delaying factor for Powell, because he's got to have justification other than simply Trump said to cut rates. He's got to have some bad numbers. That means he's got to literally wait for some horrible data points, unemployment numbers, all kinds of other data points they look at. They need to have some dark numbers. And so they can say, our other mandate is in play now, the economy and unemployment. Otherwise, he's given in to Trump. So that means if he might have done it earlier, otherwise, he's not going to do that. So he will definitely delay. That's fine. It doesn't matter. We showed charts of 2000, 2002 S&P and 7 to 2009 the S&P, and put arrows on the charts all the way down. Arrows were the Fed cut, Fed cut, Fed cut, Fed cut, Fed cut. It didn't mean anything. It meant something to gold. It didn't rescue the stock market, because once those bubbles break, the bubble takes over. The central bank is merely a road bump in the process of liquidating the bubble. And we right now have the biggest stock market bubble in US history, both in duration of time, time spent and percentage gains. So welcome to the party.
So Jay Powell, or we have another Fed meeting coming up in the first week of May. That's only 3 weeks away. In all probability, they're not going to be able to do much because we're not going to get a whole lot of information between now and then. So you're of the mind
I have no idea. I don't predict the Fed. I just know that historically, when you go back and do your homework, it doesn't matter. When they start cutting rates after a period of pause, they may raise rates for a couple of years, then they pause, and when they start cutting, the market starts down, or have already started down, and it doesn't help the market historically.
In other words, it's too little, too late. They're way behind the curve.
The fire started. You're not going to put it out with a tiny hose. They'll have to go to QEs, and those won't work either. Even when they did, if you go back and look, we did a study of this because everybody has this burnt in their memory. Oh, if the stock market goes down, big gold will go down. There's 1 month that's got everybody concerned, and that was October of 2008. The S&P dropped 30% that month, meaning a crash event. But that was already a full year off the high. It had been going down hard for a total year. And then finally, a month after Lehman went under in September 2008, the S&P puked 30 some odd percent. That's when Bernanke came in, took the little Japanese trading book, QE, and deployed it. And in November, 2 months after Lehman went under, and a month after the stock market puked, already a year into a bear trend, he finally did QEs because rate cuts hadn't been working. And you know what happened in November? Stock market went down hard again, and it kept going down till March of the next year. 30% more drop, even after he did QEs. What happened to gold? In October, it did have a sell-off. It was a corrective, brief sell-off in August, September, especially October, where it needed to correct. It had a huge move at that point. Even while the first year of the stock market had been going down, gold's still going up. It was only in that later part of 2008 that finally the stock market had a puke that gold said, oh, I need to correct anyway, and it had a very bad month. But when they did QE, stock market went down another 30%. Gold exploded in November when they did the QE and was back to its highs by early 2009, on its way to 1900. So again, what the Fed does, don't count on it helping the stock. In fact, when they start cutting rates, panic, because they're admitting, okay, that's when they scream. Okay, so they're late to the game. But when they start doing what the head of the Boston Fed, the woman who's head of that, spoke Friday a week ago and said, we've got various tools to employ if things start to happen like that. And she meant not just rate cuts, like QEs. So that was an admission. It was quite revealing.
Okay, Michael, so we discussed what's not working, the S&P bonds, US dollar, they're all under pressure. Let's have a conversation now on what is working. Gold is up 30% on the year. It's hard to believe we're only 4 months into the year and already it's up 30%. And it's like a runaway train. Every day it's up 1%, 2%, 3%. What's your take on gold here? Has it gone too far, too fast?
No, that's what everybody thinks right now. I admit everybody's screaming, "Oh, God, take profits." Okay, they've been saying that for the whole advance anyway. So whatever. I've pointed this out before, and it's not to make a projection of a target. If you go back and look at the 1976 corrective low in gold, which is around 100, it had been up to 275. pulled back to in 1976 to about 100, went up to $850 3.5 years later, an eightfold move. Okay. In the year 2000, 2001, gold was basing just above 250. Okay. Never got quite to 250, but repeatedly tried. Stock market was topping then, by the way, in 2000. Gold was bottoming. Okay. Stock market topped, went down through 2002. Gold started its bull trend. It lasted till 2011. But by the time it got to its 2011 peak, it had another eightfold move. You can see this on a logarithmic scale chart where the move in 1980 and the move to 2011 were both the same scale when you think of a logarithmic scale or ratio gain. Okay. If we do a ratio gain like that, we'll be at $8,000 plus because our bear market low was 1,050. Okay. We've only had a fourfold. Not even that. Excuse me, a 3.4 fold. Okay. We're 3,400, we're 1,050. Okay. We're not even halfway to the ratio gains seen during those prior two bull markets of the last 50 years. Now, in those environments that gold was in then were hardly as catastrophic and as monetarily likely to be stimulated by central banks across the globe to try to put the fire out. So once they come in to put the fire out, that's when gold goes really berserk. And it's only just begun. Again, look at the T-bond market, look at the dollar index breaking, look at the stock market breaking, and look at the data points that will follow. The central banks they've only woken up. They've hardly pushed the throttle. And when they do, gold will go berserk. It did in both those occasions. Only this time, the factors are far more explosive. And the alternatives in those two times were also T-bonds. If you go back and look at bear markets in the stock market, like 2000, 2002, or 2007 to 9, for example, T-bonds played pretty good then. You could have bought gold or T-bonds. They both worked out pretty good. Gold was ultimately better, but they worked. They were an alternative. They're not an alternative this time. Where do you go? You can't buy T-bonds. They're very dangerous looking. So all of a sudden, if you're looking to move money, billions of dollars out of your managed asset fund, asset manager, he's not even a gold bug, but he looks around and says, geez, it's the only place that's behaving. And when that money flows, it no longer goes in T-bonds and gold, it goes into gold, silver, gold miners. And that's what I expect to see. But the full throttle event hasn't even happened yet. And that's going to happen when that stock market blows that 4,800. The data points really go dark. T-bond crisis is suddenly not manageable. Already it's not really manageable. And the central banks have to really panic. Et cetera, et cetera. So all these things are working in gold's favor, but they haven't even hit the max point. And that's the point I wanted to make in that technical. It's a gold chart. And this gold chart is a weekly of gold. It goes back to that low that we saw in 2022. If you'll recall, in the summer of 2020, gold got up to 2,000 plus. And it labored for a couple of years up there. But in 2022, from a March high to the September low of 2022, it went down and flushed itself out, taking out some very obvious price chart levels that were in the high 1600s that it had gone to repeatedly during that time, blew those out, spooked all the price guys, and got down to $1,613. So it had broke all the price chart obvious supports. At that point in time, MSA said, don't believe it, it's a bear trap. Meaning, if you get bearish here, you're going to get trapped. Okay. Within months, several months, you were back to 2,000 again. So that chart begins at that low when gold was down at 1,600 plus. And if you look at the price chart, yes, it has this upward curve to it, like, my God, this is overdone. Okay. And that's all we're hearing for the last month or so. Gold's overdone, it's got to correct, gold's overdone. It's already had in the process of that move. If you can look at that weekly, you'll see 10, 20, 30 weeks sideways clustered where it corrected by going nowhere, full of doubt. And it's even had some sharp drops. But now it's starting to go vertical. Well, what its price is saying is, I'm in acceleration mode. I'm starting to go berserk. You can't tell how far I'm going to go. Go to the momentum chart below it. And what you'll see there, and what we've done is we've measured each of those weekly bars in relation to a 40-week average. What's a 40-week average? It's almost the same as a 200-day, almost the same as a three-quarter average. So what we do is we plot each week above or below the existing 40-week average, and we create an oscillator. And it's been going up too, but it's been living in a parallel channel. We've connected 2 peak weekly closes and 2 low, and it's a perfect parallel channel. That chart ends as of last Thursday's close, the 17th. We blew through the top of that channel today. So what momentum is telling you is that though the price chart looks like, oh, I'm ballistic, therefore highly vulnerable to a collapse, momentum says, no, you just broke out of an acceleration channel. You've begun a new game. No longer this channel confined gain. I'm going to blow through the top of that channel and I'm going to accelerate. Now, what's interesting is silver's behavior over the last 5-6 months has not matched gold's. Gold makes a high, pulls back, and takes it out. Silver made a high back in October above 33, above at 33. You can see on the top chart, the price chart, the weekly price chart, and it pulled back hard, and then came up to 35 in October of last year, and had another drop, and then again 3-4 weeks ago made a high at 35 again. So it went back up to the old high above 35, didn't go to 36, and collapsed with what? With the stock market break that occurred April 3rd, 4th, and on the opening of April 7th. A 2.5-day collapse in the stock market. Silver joined in. So did the commodity complex, by the way. Bloomberg Commodity Index, crude oil puked big time. Copper dropped pretty hard. So all commodities broke. Now, people think, therefore, by the way they treated silver in that break, that silver is just an industrial metal. And they mentally divorced it from gold, which is a mistake, because if you go back over history, they don't break apart. Silver follows gold ultimately, and often leads it, okay? But you had this huge puke in silver, and you only had, 3 or 4% drop in gold, hardly a drop. And yet silver dropped, from 35 to 27.5 bucks in a matter of days. Incredible wipeout, end of the world. Okay, then suddenly within, we're now up to 33 again. Okay, either side of that, last week's high, this week's high. What that momentum chart below shows, instead of an upward channel that gold's been stuck in, since last May, that momentum chart made a high and has created a downtrend channel. Now, if that chart on the bottom were a price chart, and you're a technician, you would draw the line we drew on that bottom chart, the momentum chart. We plotted it through 3 peak weekly closes. It's a downtrend, meaning if you now assert yourself and get back above that red line on that bottom chart, forget that it's momentum, pretend it's a price chart, you're breaking out. You've got a fresh buy signal. Well, what momentum is telling you is if you get back up in the high 34s again, we've been 33.20, I think, last week and this week. You go another $1.50, $2, get up to high 34s. So you have to get to 35 again. That's going to be breaking out, in which case it's saying, hey, that was a bear trap in silver. People made a mistake thinking silver must go down with the stock market. It's suddenly rejoining gold and is about to explode because you go through the top of that channel. That is a major momentum buy signal. And by the way, another note, whenever we can define 3 waves on momentum, down or up, clear waves, where there's no subjectivity to it. Clearly, there are 3 waves here since that peak back in May of last year on momentum. 3 waves down, that's all you get. And you've got a channel defined as well. So you've got 2 factors to employ there. You get up to the top of that channel again. So I'm telling you, if you're not in silver and you see it get back up to 34.90 or especially touch 35 again, assume it's going to launch big time. And I bet at that point, when that occurs, and we think it's going to occur, at that point, silver will launch versus gold. And so silver's relative pricing to gold, which is very cheap right now, historically very low, 1% of the price of gold. It's done that a few times before. And whenever it does, it slingshots, by the way. At that point, that's when silver says, me too. And I think that's about to happen.
Yes, I have to admit, Michael, I'm one of those investors who's very frustrated with this move in silver. And thankfully, I'm long gold, but I'm also long a little bit of silver, and I'm frustrated as hell.
Well, I'm
But
glad you're long a little bit as opposed to a lot. Yeah.
yeah.
But there's a point you might want to switch. Okay.
Now, one point I want to make about the gold, because you said a lot of people are reaching out to you and they're concerned about this move that we've seen in gold in the last few weeks, and they think it's gone too far too fast. And one thing you did mention was central banks, and central banks have been large buyers in the last 3 years, ever since the invasion in 2022. They're acquiring approximately 25% of annual production, which is a massive number. And that's the official number, according to the World Gold Council. Maybe the number is significantly higher. And then you can't forget the fact that you have a bank, central bank like China, who is holding $720 billion worth of US debt, and they're probably selling it as we speak. Japan's been a big seller of it. And these same guys or these same banks are out there buying gold.
Yeah. Well, that's true. And that's a factor, but we don't factor it into our analysis because momentum doesn't care about, whether there's a manipulation in the silver market. I've seen manipulation in silver and gold before over the last decades. Okay. There was plenty of manipulation in the bull market back in 72 to 75 when gold was legalized in 75, went to $200. And then there was big manipulation in that 1979-80 move in gold where the IMF came in and dumped tons of gold in the last year of that move and finally just gave up. It used to be when they'd sell it, you'd get a drop in gold a bit. After a while, you wouldn't even get a drop. Gold would just eat it up. And that's when they said, oh, they quit. So if you talk about manipulation, they were huge quantities. I don't know. I forgot the numbers.
I'm not suggesting there's manipulation going on. All I'm suggesting is central banks are selling one asset to buy another asset. They got to replace it.
Yeah. Well, also, when the dollar breaks down, what does that do for a foreign bondholder of U.S. Treasuries? It's not merely that the bond market's losing value, but it's losing value when you convert it back to your currency because the dollar's losing value. The dollar just dropped 6%. So if you're a foreign investor in U.S. stocks or bonds, back a month or so ago, you've seen like a 20% drop in the stock market, but you've now seen also a 6% drop in the dollar value of your stock holdings. So it impacts you two different ways. So that dollar drop is a wave factor for T-bonds as well. And it's, now it's become a factor again for gold. The historical correlation between the dollar and gold is not great. If you go back to where gold peaked and bottomed in 2015, dollar index was 97.5. Right now, today, it traded in the 97s again. Okay, really. Okay, unchanged versus 2015. Well, if gold were unchanged versus 2015, it'd be $1,050. So even though the dollar hasn't gone anywhere for a decade, when you look at the sideways, where it is now, gold has, doubled and tripled. Okay, so but this time around, when the dollar breaks, it could be sudden and fairly dramatic, as opposed to this type of behavior. And I think that could create more wave impact under gold. So we're now down to a very narrow world.
And
Although
you mentioned that your
pardon me?
You mentioned that your target for gold was 8,000.
No, that's where it's been before on a ratio scale.
Right.
It might go to 20,000. I don't know. Seriously, I don't know.
And you said the big breakout on silver is at $35.
You go back up to 34, 35 area, you better turn your hat around if you're skeptical because something's going on that you got faked out by that stock market sell-off, which brought silver down. Now, I found it interesting today that the stock market now has had another 3 and 4 days bad selling. Silver's gone up there in those 4 days.
And so where do you see the price of silver going ultimately?
Minimum 2% of the price of gold, because if you go back over 50 years of data, In 21 of the 50 years, silver's at least traded to 2% of the price of gold. And that's not even in bull market years. We're now at 1%, meaning silver could double in value to gold. So if gold goes up to 4,000, silver went to 2%, $80 silver. Okay. And we're seeing the technical potential right now. Silver's trading just below the 1% level. You get back above that 1% by much. Where you divide the ounce of silver into gold, you find it's a little more than 1%. Wake up, because that was a bear trap on the spread as well, meaning that silver's dropped below 1% into that level. It's historically very low. You can go back and look at decades and see, ooh, that's low. It's also a slingshot level. Meaning when you turn up out of there, it's washed out as much as it's going to be washed out relative to gold, and it's going to regain. And I say 2%, that's routine. In bull market years, silver gets up to at least 3.5% of gold. In fact, in the 80s, 1980, it was 6.5% of the price of gold. So don't be shocked if silver goes from like 1% up to 2 or 3% of the price of gold. Well, if gold's going to go up to a norm, logarithmic ratio scale move, like it did in 1980, it did, et cetera. You go $8,000 gold, we'll do 2% of that. Okay. It sounds insane. It's not. Okay.
So, Michael, I just want to summarize a few of the points that you've made. You're very concerned about the S&P and the NASDAQ. You said the S&P ultimately, can it go down 50%?
It could go a lot further than that. It's not really the issue of how far down it goes. Like 2000, 2002, S&P went down 50%, but the NASDAQ 100 went down 82%. And then the other problem was it took 13 years for the S&P to finally get back up in nominal price and ever take out that mid 1500 high that it made in 2000, again in 2007. So you had a wasteland of up and down until 2013. You ever took it out in 2016 before the NASDAQ could ever get back up to its dot-com high. So not only was it a percent drop, but from an investment point of view, if you didn't get out at those tops in 2000, you had all these a decade and a half of, effectively wasted time. And when you factor in the decay in the real value of the dollar, it was even worse than that.
So let's stick to round numbers and just say the S&P tops out at 6,000. Cut it in half, it goes down to 3,000 ultimately, maybe whatever. 2 years out. NASDAQ goes a lot lower, okay, just because of the makeup and the number of the companies that are involved. The bond market is going to come under pressure. The US dollar is going to come under a lot of pressure. So where do we find protection? We find that in gold and silver. Your target on gold, ultimately $8,000.
Minimum, I would say.
Silver, 2% of that number. Let's just use $160 as a potential.
Yeah.
What would you say? There's a lot of investors out there right now that are very concerned about what's going on, and they don't know how to position themselves. And maybe they haven't gotten into gold and silver yet. They think maybe it's too late because of the moves. What would you say to those investors?
I would say that if you go back to 35 silver, consider it fresh game begun. First off, on price, that's a triple top. If you go back in a point and figure of silver, and you find it back at a triple top, it ain't going to stop. It's a launch pad. We went to 35 down to just above 30. Then we went to 35. Then we went to 28 on a $1 chart, 27.5 actually. You don't go back and touch 35 again. Now, momentum says the upper 34s. I'm going to blow that channel out. So it's not just price saying I've got a pending triple top breakout, which will change the tenor and tone of this market. Plus leave a lot of people behind, obviously, who got out. But momentum says, yep, fully validated. I've got a massive channel that goes back, come May, a full year, a 1 year parallel channel that says you get back to 34.90 again, and I'm going to blow your head off. So at that point, even if you're not in silver, this is at least a fresh, major, long-term entry point. If you didn't get in before it at proper zones. And if you ignored all the sell-offs, which would have been a wise thing to do. Even now at 33, if you go back over the last several years and look at all the sell-offs, if you tried to get out at every one of them, did you ever get back in? That's the issue. And right now I'm saying this is a fresh level. So even if you miss the move, you get back up to that level again, expect silver to then launch net price, but also performance-wise versus gold.
So there's still opportunity to get involved in both gold and
Yeah,
silver.
yeah.
Well, Michael, that was a great discussion, and I want to thank you very much for spending time with us today. If somebody would like to learn more about you and about the services that you offer, where can they go?
It's olivermsa.com. MSA for Momentum Structural Analysis. Take your time. We discuss our method at length, probably bore you to death, and got a lot of sample reports from the past calling tops and bottoms in the stock market in particular. So consider.
And I will include a link below in the show notes. Michael,
Thanks.
once again, thank you.
Thanks, James.
Did you know we're now on Spotify and Apple Podcasts? So now you can listen to us on Spotify or Apple and listen and learn when you're stuck in traffic on the 401 in Toronto, the I-95 in New York, or the I-5 in LA. So be sure to subscribe and follow us on Spotify and Apple Podcasts. Randy, thank you very much for joining us today. How are things in Vancouver?
Fantastic, Jimmy. Thank you for having me again.
The pleasure is all mine. Randy, before we do the deep dive on silver and gold, I want to first provide some background to investors who might not be familiar with the royalty and streaming models. And Wheaton Precious Metals is not a mining company, but a financing company that provides financial solutions to mining companies. And it does this through streaming agreements. And before we begin our discussion, why don't you just tell us what a streaming agreement is and how it's different from a royalty agreement?
Sure. A streaming agreement is a contractual partnership between an operator or an operating joint venture group or whatever and the streaming company. And we supply capital up front. And for that capital, we get a share of the metal production. And typically what we'll focus on is a non-core byproduct. So from a copper mine, we'll take the gold production that comes from that copper mine, or we'll take silver from a lead zinc mine. We do also do gold streams on gold mines and silver streams on silver mines. There's not a lot of silver mines out there, but yeah. And so we're focused. It allows us to focus specifically on that byproduct, that precious metals byproduct. And when that metal is delivered to us, we make a production payment, and that is fixed and agreed to by the contract. And so it's not subject to inflation. And it's predictable. It's a fixed cost and very healthy margins. And so currently we're operating at over 80% operating margins with our current production. And it's a great way of investing into the precious metals space, especially because it's such a low risk option. It takes the cost risk out of the investing decision in the precious metal space.
And maybe you can just expand on some of the risks or some of the benefits associated with investing in a streaming company like Wheaton as opposed to investing in a mining or producer.
Well, the biggest challenge that mining companies have is when commodity prices climb, lower grade material becomes more economic, and it works its way into the processing stream at these mine sites. And when that lower grade material gets processed, it automatically drives up costs on a per ounce or a per pound basis, depending what your product is it precious metals or base metals? But it always will drive up costs. And so that's one of the challenges that you have, is that costs will chase commodity price in a mining company. But when you have a streaming company, our costs are fixed. They're defined by the contract. And so there's no surprises. And as I said, we don't get any inflationary pressure or even cost pressure this way. Those ounces we pay the same on a per ounce basis, whether it comes from low grade material or high grade material. So that confidence is what makes us so attractive to investors.
And if the miners at a mining company go on strike, that doesn't impact you, or if a mining company engages in excessive exploration that leads to a lot of additional ounces, you don't have to put up one penny for that.
That's exactly right. If they do go on strike, I mean, we get a share of the production. And so if the mine actually shuts down because of a strike, then we have to wait, like the operator has to wait for that to get resolved and move forward. One of the things that we've been really successful with at Wheaton is selecting high margin, high quality mines. And what that means is that not only are we profitable at these mines, but our operating partners are also very profitable. And what that does is provides a lot of incentive to make sure that any labor disruptions or anything that disrupts production, there's a lot of incentive to get that fixed and get the mine back up and running and generating, again, good, strong revenues for all the stakeholders, including the streaming company.
And one of the benefits that I really enjoy about royalty and streaming companies is this leverage to the gold and silver price. And even though stocks and bonds have been under pressure here in recent weeks, the price of gold is up 20% on the year, silver's up 10% on the year, Wheaton is up significantly more than that. Maybe you can just touch on the powers of leverage.
Well, and in fact, that's an advantage that streams have over royalties is that we actually have a production payment on a per ounce basis. And so we have leverage on that commodity price just by virtue of that fixed cost payment that we make on a per ounce basis going forward. So it actually generates even better value than a royalty does in the space. And really that's what it comes down to is the fact that when if precious metal prices went up by 50%, our cash flows would climb by about 60, 65. We are a high margin business, but we still do get that leverage. And so our cash flows would climb by over 60%. And it does position us very well for taking advantage of that. But again, because we don't have the cost pressure that comes from the mining companies, what we know is that our cost on a per ounce basis is confident. And so we're not going to lose it to cost increases.
And Randy, many people might not know this, but Wheaton Precious Metals was once known as Silver Wheaton because you were just focused on silver, but now you're focused on both gold and silver. Why did you make the transition to both metals?
Well, the challenge that we were having in the silver space is that there's just not enough opportunities to invest into it. It's such a small market to begin with, but secondly, there's just not a lot of new mines coming on. Typically, when we supply capital, it's to fund construction and development of new mines, and we just didn't see enough capacity in the silver space to satisfy it. So, about probably 12, 13 years ago, we started looking at gold at the same time. And just by virtue of the larger gold market compared to silver, we're now a dominant gold company. 60% of our revenues comes from gold, about close to 40% comes from silver. And so gold is definitely, and when I look at the opportunity set we have in front of us, it's heavily biased towards gold. There's a lot more gold opportunities out there than there is silver. That being said, I'm still a big silver bull. If I was going to pick a favorite metal, it's always been silver over gold.
So let's talk about that now. I want to ask you about the silver price because gold is trading at or near all-time highs, but silver is nowhere near its all-time high, $50 that we saw back in 2011. I can't believe it was that long ago. But even when you look at the gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, it's currently trading around 100 times versus 30 times back in 2011. And I also hear many bullish comments about silver production, how production keeps declining every year. It's around 800 million ounces, but yet the demand for silver keeps climbing at around 1.2 billion ounces. Why is silver lagging behind the gold price?
Well, silver has always lagged behind the gold price. It's a bit unique. It depends on what drives the gold price to begin with, right? Because silver, it generally only gets treated as a precious metal by the retail market. It's the retail investors that come into that space. And to be honest, this gold bull run that we've seen in gold prices over the last 4 or 5 years, and really over the last couple of years, it started at central banks. It was central banks around the world, specifically in the eastern part of the world, Asia, China, obviously, Southeast Asia, the Middle East, and even parts of Eastern Europe. Central banks were the first step of driving up gold, starting this run on gold prices because they started shifting away from US dollar and into gold. And they are not chasing silver. It's been a long time since we've seen central banks investing into silver, and none of those banks were interested in the silver side. So there wasn't support for the silver, but this was clearly evidenced by the fact that even though gold prices were going up, ETF holdings in the gold space were dropping. And if ETF is a really good reflection of retail demand. And so even up until about 5-6 months ago, ETFs were dropping even in the gold space. What we have seen over the last 4 or 5 months is gold ETF holdings climbing, and that tells me that we're starting to wake up the retail side. But it hasn't fully waken up, and it always takes place first in gold. You go back and look over the last 50, 60 years, every time gold goes for a run, silver will lag, and then it will outperform. And so I do think that we're not quite to that point yet. We haven't seen a total awakening up on the retail side of gold, but I can tell you there sure is a growing appetite for it in today's world. Silver should follow shortly, after that as we move forward. the fundamentals are very strong there. So I wouldn't expect I wouldn't expect anything different this time around.
And you touched on this earlier, but 75% of all silver is produced as a byproduct, and lead zinc mines are a big producer of silver. And have you been involved in any silver deals in recent years?
Well, we've got a couple of streams this year where we're going to be getting silver from. We get some byproduct silver from Artemis at the Blackwater project here in BC. We have Mineral Park starting up production in September of this year down in Arizona. It's a copper moly mine that also has silver byproducts, so we'll be getting some silver from there. We've got some good silver growth. Antamina, which is one of our flagship assets, should be increasing its silver production dramatically over the next 2-3 years as they move into a higher grade portion of the ore body. So we should see a 30 to 40, maybe even as high as 50% increase in silver production there. So, I mean, we are seeing some growth in the silver space, but, the challenge is, as I mentioned earlier, is that most silver is produced as a byproduct from mainly lead zinc mines, even a bit from copper mines. And we're just not seeing a lot of investment. The prices just haven't been high enough to justify any substantive investment into those commodities. And so if they're not getting built, we can't, invest into them. There has to be enough of a shift in demand for copper and lead and zinc to start pushing the silver production from there.
So if copper is trading somewhere between $4 to $5 a pound, where do you see it going, or where does it have to go in order to see mines being built?
Oh, I think you need to see something up well over $5, if not over $6 a pound, before you start seeing, and it needs stability there. It can't just shoot up there and then come back down. I think everyone, investors, the mining companies, the ones that have the assets, the biggest challenge with some of these base metal projects is they're very, very capital intensive. It's not $1 billion; it's multiples billions of dollars, maybe up as high as $10 billion for some of the larger projects out there. And so those are huge capital commitments that, that are going to take, 3 to 4 to 5 years to get built before you actually start seeing any cash flow from that. So you have to have some confidence in terms of the long-term price projections. And it does look good, especially for copper, especially, with the drive towards electrifying the world, but we just haven't seen it in price yet. And without the price, nobody's going to make the commitment.
I want to move on now and discuss your balance sheet and capital allocation. And because of these high gold and silver prices, you're spinning off a lot of free cash flow. Maybe you can speak to that, how much you are producing and how you're going to allocate that in the coming year.
Well, this year we should be producing somewhere between 600 to 670,000 gold equivalent ounces. We've got 4 mines that are starting up production this year, so it's a pretty broad range. But if we get Artemis is actually doing relatively well on their startup, and we've got, as I said, 3 more mines that'll be starting up over the course of the year here. So Goose with B2 Gold is sometime in June. Mineral Park is in September, and sometime in Q4 we're going to start seeing our first production from Platte Reef. So, but that's 635,000, center point on the 600 to 670. That at current prices and with our low cash cost on a per ounce basis will generate about 1.5, maybe even a little bit more than that at these prices, $1 billion of free cash flow. We do have a pretty healthy dividend. We have a policy of trying to lead the pack in terms of returning as much capital as we can to our shareholders, a higher percentage of our revenue on a per ounce basis to our shareholders than any other company in the precious metal space. So we'll always focus on a progressive dividend that keeps us at the top of the group from that. So there is some money that goes back to dividend, but the rest of it, we're busy trying to look for new projects and put it back into the ground and grow the company by looking for high quality assets through additional streams. And as I mentioned earlier on, we're not seeing investment into the precious or into the base metal space, the copper and the lead zinc miners, in order to, try and get the byproduct gold and silver from them. But what we are seeing with these high gold prices is a lot of activity in the gold space. And so I'm comfortable that we'll be able to put some more money to work this year, and continue to fund this. We've already got such a strong growth profile. That 1.5 billion this year, if prices stayed flat, that'll be up over or very close to 2 billion. I think it's 1.9 billion by 2029. So it's really exciting times. We've made a lot of investments over the last 4 or 5 years, and they're finally going to start delivering their rewards over the next 3 or 4 years.
And Randy, does this high gold price help or hinder your ability to find good deals?
Well, it definitely drives activity. With prices like this, everyone wants to build their gold mine, right? And they're moving forward. The biggest challenge is, and it's always been a challenge that that we're happy to look at is focusing on the quality assets. We're always looking for the assets that have the highest operating margins. Again, if there's any challenges at the mine from a production perspective, if there's labor unrest or anything like that, if it's a high margin mine for the operators themselves, they're going to put their best focus on ensuring that that mine gets back up and running and get the issues resolved as soon as possible. And so it just helps if you've got aligned interests, and if it's delivering high margins to both the operator and to Wheaton, it's the best kind of a structure to have.
And Randy, you and your team are always on the road meeting with investors, and you were recently in Asia and also Australia. And I'm curious, what sort of questions or comments are you hearing from these investors? And are these what you would call gold-focused investors, or are they generalists?
No, we're actually starting to see quite a few more generalists. And in fact, the number of new conferences that I've been invited to over the last 6 months has dramatically increased. And these are big conferences that are just basically, institutional investor conferences, but they just don't have resource. They haven't had a resource presence for a long time. And all of a sudden now we're getting invited as the gold representative because there's an interest, there's an appetite, a growing interest and appetite for gold. And so even at some of the stalwart conferences that we've been to of late, a dramatic increase in new faces and new funds coming in to have a look at it. So there's absolutely no doubt there's a growing interest in terms of precious metals, and I think it's just getting in more intense. And this last trip that I did over to it was a 2-week trip, 1 week in Asia and a good chunk of a week down in Australia. A lot of new faces. And a very healthy appetite. Again, the fact that we have such a lower risk profile than your traditional mining company, and yet we still provide the upside, the leverage, and we provide a dividend. Wheaton is looking like the best way to dip your toe in the water and come into the precious metal space because we do such a good job of limiting the risk, and yet we still deliver all the upside, the exploration potential. These are all life of mine streams. And so as these mines run, we continue to receive our share of the metal from these mines. And so the exploration expansion potential and the commodity price exposure, it's something that resonates as a way for people to come into the precious metal space. And so we've had a healthy appetite of investor interest.
And when you're meeting with these investors, what are some of the common questions that come up?
Well, I think our growth profile really stands out. Again, the fact that we've got 60% over the next 7 years or 40% over the next 5 years, and then still another jump up after that. And so one of the first questions they'll have is what are the risk factors within that? And what's nice about that growth profile is it's coming from about 10 or 12 different mines that are going to be adding to our portfolio. As last year we had 18 mines feeding us metal. By 2031, we'll probably have, I think, over 30 mines delivering us metal. We have 4 new ones coming on this year, 2 next year, 2 the year after. And so lots of growth on that front. And so everyone wants to understand and get comfort with the low risk profile that we have there, especially because it's diversified across so many different assets. We're really comfortable with that. But I think the second thing that they're curious about is silver. We are getting a lot more questions on silver. And given that our company is the size of a scale, we are probably one of the best and easily most profitable ways to invest into silver. To be honest, most of the silver companies that you hear nowadays, they're dominantly gold companies that have a bit of silver byproduct production. They still have silver in their name, but from a silver torque perspective, Wheaton still provides probably one of the best exposures. And so that whole combination of the growth and the silver torque is something that's really catching investors' interest.
Randy, as we wrap up, many investors are trying to make sense of this current economic environment. There is a lot of volatility out there, and stocks and bonds have been really under pressure. Gold and silver are hanging in relatively well. Wheaton Precious is doing relatively well also. But what would you say to investors who aren't in gold and silver yet, or might not be involved in a stock like Wheaton Precious Metals? Is it too late to get in?
No, I don't think it is. I really do think you have to ask yourself the question, where does the strength come from that's going to support a strong US dollar? Because that's really, to me, the aspect, the fact that makes me so bullish about precious metals is that the debt levels and the debt servicing levels and the challenges of managing it. And now what you've got because of tariffs is a whole bunch of countries around the world, a lot of which hold U.S. debt, that aren't all that interested in being supportive. And so I think it's the current environment, and we're going to see this for at least 3.5 more years. I think it's set up very well for what I call a comfort metal. That's what gold is. Gold and precious metals itself is a great way to store value in times of turmoil, and that I think fits current times pretty well. The amount of up, down, the volatility that we're seeing in areas that are typically and traditionally relatively stable. That's the advantage of precious metals, and so gold is by far the more stable, just by virtue of its size and scale of its market. But silver definitely adds a nice touch of torque to the precious metal space. So the combination is a great package to have. Everyone should have some gold in their portfolio. And I think Wheaton is a good foundation investment in that. And then you can sort of test into some riskier sides to try and play the leverage game a little bit more. But Wheaton should always be your foundation investment in that space.
And if somebody would like to learn more about Wheaton and what streams are and how they can benefit their portfolio, where can they go?
Well, the best thing is just to go to the website and you'll have the contact details. We've got a team here that's ready and willing and very capable of answering questions. We get it, this is a unique business model that we created 21 years ago. And so there are a lot of questions about it. It's really taken off. As I said, we only started investing into the gold space about 13 years ago. And so it is a unique way of investing into the precious metal space that isn't really well understood, beyond traditional investors that know the space. And so for someone coming new in, it's wheatonpreciousmetals.com, I believe, is and just look it up and connect up with us. We've got a full team waiting to help you out. And of course, we're also attending a lot of conferences around here of late. And so stay tuned. We might be coming to a conference near you.
Randy, once again, thank you.
Always a pleasure.
Well, that concludes our virtual silver conference, and I hope you found it useful. If you did not have a chance to hear all the presenters, the conference will be on our YouTube channel, Bloor Street Capital, and all the presentations will have chapters so you can easily go to a specific topic or company of interest. Be sure to subscribe to our channel, Bloor Street Capital, and also hit that notification button to be kept up to date on upcoming events. You can also follow us on Spotify and Apple Podcasts. Once again, thank you for your support.